Hey guys, so I'm Michael Mnatsakanian. I'm going to give you guys a quick intro. Over the last 5 years, I've developed a very nice portfolio that has allowed me to retire my wife a few years ago and then fully retire myself last year. And going into that journey, I'll give you guys some of I don't know where everyone is on their investing journey, but 7 years ago essentially is when I understood the concept of real estate investing as a path towards freedom. And that's what this whole thing is about. I have a very clear statement that I don't care about houses. I don't care about the assets themselves. They don't have value to me. I'm not passionate about houses. I'm passionate about what they do as an investment vehicle. Prior to starting real estate investing and learning about it 7 years ago, all I knew is I did not want to work for someone else for the rest of my life. And I was willing to work, save, invest, whatever I had to do so that I did not have to work for someone else for the rest of my life. And I was going to do that first with the stock market. I was going to invest passively in index funds. And over time, over 40 years, I'd have $2-3 million as long as I save 50% of my income, be able to live off that. And I said, okay, well, that's cool, but I'm the type of person, like everyone in this room, who is willing to invest in education, who's willing to put in more work so you can, A, expedite that journey so you can be free much sooner, and B, you can have much higher returns, especially if you buy and hold the way that I do, which is raising money. Right? If you're only investing your own money, real estate is a phenomenal strategy because you get leverage. When you buy a property, you're putting, well, creatively, I guess sometimes you put little to no money down, but you're putting 10, 20, 25, 30% down, but you're leveraging debt to be able to buy that asset, which already makes it a massive benefit compared to any other investment vehicle. I'm not going to overly caveat like I normally do. I'm like, oh, well, businesses, you can kind of do the same thing, but I'm not going to do that today. We're going to be pretty broad. The reason why I fell in love with the concept of real estate investing was the leverage was the first thing. If I put in $10,000 or $20,000, I can have ownership of an asset worth $100,000. I can have cash flow and a cash-on-cash return based on my initial investment of $20,000 and the ownership of a $100,000 property. I will have the $100,000 property appreciate even though I only put in $20,000, so 20% down. I will have another person living in my property, paying down my debts, which will then further build my wealth and allow me to be more financially free. And I don't have to pay taxes, which was another huge benefit of real estate investing. So when we talk about buy and hold investing, this is the thought process that I went through to understand, okay, the reason why I'm going to invest in this vehicle, I can leverage a portion of my capital to fund and acquire larger assets, right? Leverage, and that will provide me cash flow, which is what makes you financially free, your monthly profits. Is everyone clear on cash flow? I mean, we're Owners Club, but if you're not, I want to answer that because I was surprised yesterday. Cash on cash return. Yeah. So, all right, is everyone familiar with cash on cash return? Especially after yesterday since I answered it. Okay, but like that's the idea, right? Like you're getting cash flow based on this asset worth significantly more than the money you're putting in. And cash on cash return is basically what is my return from that? I always compared it to the stock market, which I can passively invest in the stock market and get roughly 10% returns. That's the cash on cash return comparison between real estate stocks. However, with real estate, you get to leverage that. You get to leverage $80,000 of someone else's money, or we get the appreciation, the debt pay down, and the tax benefits. All that further benefits your wealth. And buying and holding, it's you buy and hold a property, but there's a whole process, a whole path to truly develop your freedom and your wealth. And the longer you own assets, you get the cash flow, but the longer you own assets, your tenants are paying down your debts, your properties are appreciating in value. That property value is compounding the appreciation. So if it's $100,000 and it goes up, let's say 5% is $105,000, goes up another 5%, it's not going up 5% of the $100,000, it's going up 5% of the $105,000. That continues to compound. Debt pay down, appreciation is building you equity, building you wealth. The thing Pace taught me a year ago during my one-on-one with him is I was very good at acquiring assets and understanding them from cash flow and cash on cash return. However, I did not have a long enough time horizon for the wealth benefits and how that will play to my eventual exit. Because the idea is not to own hundreds of properties for the sake of it. It's to get the financial freedom that comes from it and all the benefits that will come from that. One of the big ones is equity. You will only tap into that equity if you sell or refinance your properties. Well, I'll tell you what Pace told me, right? The concept is stack a lot of these properties, become financially free through cash flow, let your wealth build up over 5, 10, 20 years because we have this great interest rate debt as we're buying deals creatively financed. I have properties 0%, 2%, My lowest sub 2 loan is 2.25%. Plenty of seller finance, 0%, or hybrid deals with 0% is in there. But we're carrying this great debt that we've leveraged the majority of the property value, and we're building this wealth. And over 5-10 years, you're gonna have this mass amount of equity. He made me specifically, he knows I'm a spreadsheet guy, so he made me model out, okay, how many properties would I need based on some assumptions? How would I get to $10 million of equity in 10 years? And the idea is you take that, you sell that, you 1031 that into a bigger asset, buy that cash, okay? Then you pull the money out of that. All of this process is tax-free, and then you lend that money out. So you became financially free. 10 years later, you are building this over time. We'll just say 10 years, just a rough horizon, but you're building this massive wealth in addition to your cash flow and financial freedom. That wealth will then now make you so much more returns more passively by liquidating a portfolio, putting into a larger asset tax-free through a 1031 exchange, pulling your money out of that property and lending it for 10, 12% returns fairly passively. If you have a lot of money, you don't have to do the way we lend, where we lend on individual deals. You can lend to more institutional players, way more passively, way more secure than kind of the way that we do it, but we don't have access to that yet because we don't have enough capital for the most part to take advantage of that. The way Pace does, it's very passive for him to lend his money out. So with all that being said, buy and hold is kind of everything. To be able to do so, to be able to become financially free, to be able to build this massive wealth, well, you need to be able to buy and hold properties. So you need to have the ability to find great deals, ability to analyze what is a great deal, what is not a great deal. You need to have the ability to fund those deals. You need to have the ability to then close on those, minimize your risk during due diligence throughout the due diligence process, and then maximize your returns through effective ownership. You don't build wealth long-term through real estate if your properties do not perform. A lot of people in the sub-2 community, probably Owners Club as well, buy assets that they should not be because at a certain point it becomes fairly straightforward to find deals and fund them using other people's money. I'm not saying we all don't make mistakes, we do, but there's people who have no thought process at all when it comes to buying and holding these portfolios. Well, I just told you, Pace's big thing, and a big thing of mine is this wealth component that's going to build in the background. That will make you, for numbers, we'll say I have over $10,000 a month in cash flows, pretty much double that through my real estate portfolio. But I have 5 times the monthly benefit through ownership benefits, through debt pay down, through appreciation, and I don't have to pay taxes on any of it. And I have a lot of active income coming in now as I educate and help other people connect capital, raise all these various things that I do. I don't have to pay taxes on that because of real estate, being a real estate professional. And I say all that to understand, that's why I challenged Marcus Lemonis yesterday, where it's not just cash flow on cash return, because with real estate and businesses, but you get the benefit of leverage, and it's really, we're building towards wealth. And that was a big thing from Pace that I learned based on that exit. So with buy and hold, we can talk about literally any of that. I just gave you the tip of the iceberg for everything. We can talk about how you find deals, how you analyze deals, how to capital raise, but not just reaching out to people, but how do you structure your deals effectively so you tend to be able to keep more ownership because you're structuring it well. There is a strategy to it. Not every person, even the same deal, will raise the same way. And actually Pace talked about that. You get more eyeballs. That's one of the ways you raise capital at better terms. You're a more proven operator. There's a variety of ways we can dive into any of that. And then operations. So I primarily buy and hold co-living rentals now. Over the last 5 years, I've acquired over 70 properties. The majority in the last 2 years, almost exclusively, or over the last 2.5 years, almost exclusively, buying creatively financed deals, raising the money from private money lenders and private money partners to fund those deals, and then leveraging the co-living management strategy. I've bought properties traditionally. I'm a veteran. I've used my VA loan to house hack. I've structured mortgage methods for deals that I've directly done my own acquisitions on. I buy a lot of my deals now from wholesalers for the sake of scalability. I just pay them to get me deals that I want to buy. Perfect. And then I primarily manage them as co-living. I have long-term, I have short-term, I have mid-term, but I can make the case all day to you guys if you'd like me to. Why for co-living over any other management strategy right now, but primarily the accessibility, the cash flow, and thus the cash on cash return, even though there's higher entry costs, and the ownership benefits. Compared to most other strategies, especially long-term rentals, you're not only going to get higher cash flow and cash on cash return, you're buying bigger, better properties in better locations that appreciate more, that have larger debts that get paid down. You have larger debt pay down benefits, And if it's a more expensive property, you get better tax benefits. So there is a case to be made that an RV park will pay you the same cash flow, in theory, as 10 co-living rentals. We'll just say $10,000 a month cash flow on an RV park versus 10 co-living rentals. It's kind of where my numbers for me, well, that's disingenuous because most of my co-living rentals are $1,500 to $2,000 a month. Because I raise money, I split that with my partners or pay lenders. So I'm taking home around $1,000 a month. Let's say, okay, 5 co-living rentals versus 1 RV park. The reason why I say co-living is more accessible is because there is a finite amount of RV parks. It is very competitive. We are not in the starting phase, in the beginning phase of RV park investing. It is already common knowledge. There are courses, there's education, there's huge communities around it. There's only a finite amount of everything, but there is a much smaller amount of those deals. So it's less accessible as opposed to, there's a lot more single family homes than there are RV parks. First reason why it's more accessible, just the volume of it. Yes, and because there's more education, there's more people actively looking for that smaller amount of RV parks. Maybe there's more people looking, even if it was like more people looking for co-living than there are RV parks, the percentage is vastly different compared to how many assets there are to invest in. And because we're just at the starting phase, we're literally at the start of co-living rentals in this as like a key investment strategy. Not to say people haven't done boarding houses, sober living homes and all that, but we're really in like when Bitcoin started taking off, right? Like this is how I compare co-living to Bitcoin is essentially, Bitcoin like came around in like 2009, but it really took off massively. It grew tremendously, but in 2017 is when it started getting popular. Everyone wishes they could have bought it in 2017 for a few grand, but anytime before that, it was too much risk. There wasn't enough data there to say, and it was very inaccessible. It was very hard to do that. So I compare that to co-living today, whereas the main platform for co-living management is the PropStream platform. They just finally passed 20,000 units this year. They'll probably continue to add $20,000 a year every year moving forward. So you're in the pre-Bitcoin exploding era of co-living. So because we have this opportunity, this blue ocean opportunity of a lot of deals, just taking single family homes in these core co-living markets and then renting them out by the room, you have less competition because there's less people that currently know about it. So there's more houses available. There's less competition currently because it is trending at this point because you've heard everyone talking about it, but very few people are actually doing it, right? So it's the opportunity for you to be able to take advantage of that because there's more houses, great returns, and we're kind of at the starting phase of it becoming it's like, here's another one, like Airbnb 2018, 2019, 2020. Right? Versus doing it 2022, 3, 4, 5, right? Much more challenging. You have that opportunity in front of you right now to take advantage of it. And because it is trending, but still not something that is fully like universal right now, you also have the accessibility of raising more money. So accessibility with more opportunities available. It's accessible because there's less competition right now. It's accessible because it's got much higher returns, both cash flow and ownership benefits, that it makes capital raising more easy to do. So can you go and spend 6-12 months finding an RV park and buying that? Of course you can. But at the same time, you can go and take that same time and energy, focus on co-living because there's more of them, there's less competition, and a lot of traditional investors will not touch this for a while. It's still too risky for a lot of them, which is fine for us because then we get to dominate in this market rather than waiting for that one $80,000 long-term rental that cash flows $200 a month, right? So it's like we get to take advantage of this right now. And because it is trending, we have to raise the money more easily for it because it's got better returns.
What are the best markets?
So this is where I talk about PropStream. There is a lot of data available on the PropStream platform. Okay. Who here is familiar with PropStream? Not everyone. Okay. Who here has signed up for a free host account, not a rent account? Great. So if you sign up for a free account, you get access to all their data. They have a full-on map of the entire country and their core markets and their emerging markets. Not only do they just show you a dot on a map, they tell you how many current rentals are there, how many are upcoming right now, how many people in the last 30 days in that market have looked for housing on their platform. What is the average going rate for properties that have a shared bathroom versus a private bathroom? What's the average occupancy? If you're not leveraging kind of the biggest data, you're making it more difficult on yourself. So PropStream, number one platform for it. We manage several properties through PropStream. We also do several without PropStream. But if you're not leveraging it at least for data, you're making it way harder on yourself because we've never had the ability to be able to get this data in the rent by the room model. Does not mean you cannot rent by the room. Jeff and I on the Texas co-living deal, we're not using PropStream. It doesn't mean we don't leverage the data from there. We're just marketing directly to tenants, and we have that in certain markets as well, but we're leveraging the data that's available. Like if you want to be a good investor, it's not just find the deal, it's make sure it's the right deal. Best way to do that is to understand the data, right? And now that's why it's more accessible, because there's more data. Getting back to the Bitcoin thing, right? Like Bitcoin was really hard to buy, but pre-2015, it got more popular and much more accessible. There was a lot more ways to buy it, and that's kind of where we're at with pad split. The risk has been minimized. It's more common, but not super popular yet. There's still plenty of runway, and there's a lot of data now that you can leverage to hedge your investment risk, because you have the data to look at. You're not just like gambling or taking a risk. You have a lot more data. So pad split is the number one way to get that data, and you asked.
Are there any like 1, 2, 3 things you're looking for? If you see a single family home, like what would make a good co-living situation?
Can I ask, what kind of buy and holds are you guys interested in? And then I'll get right back to that, because I did a whole free training, like 6 hours of this that you guys can register for free. Talking about all this stuff as well.
Marketing, like how much you're spending, how many deals you're getting for your marketing, what the approaches are.
For me, okay, my buy and hold, okay, so my acquisition marketing. And I can give you that number very easily because I have one core strategy.
Michael, I'm interested in co-living.
Okay.
From co-living strategy, what is the acquisition strategy?
Of
How do
deals?
you acquire the
How to acquire
properties?
co-living
Yes.
properties?
And again, the difference between you and other people, Michael, right? As of today, you may be having a big team who may help you to acquire the properties, right? So the
A little bit. I mean, I've done most of it myself and then hired an operator, but I'll expand on what my team looks like now, 470 plus properties and all that, so you guys can see the journey. And I could even explain what the progression of my business and organizational chart or whatever the structures look like, if that helps. So.
Did you say 470 properties?
Over 70, not
Over-
400.
oh, okay.
Jesus, no. I would never, like, pace it. You don't want 400, you don't want even over 100 single family homes, right? Like, they just, at a certain point, it's not worth it. You can, and this is what I can talk about as well. Because I am primarily, the skills that you develop to be able to scale up a portfolio to over 70 properties, 50 properties, whatever, one of those big skills is capital raising. One of the big things I have the ability to do now is raise funds and partner with operators, so I don't have to do all of the freaking work involved with finding the deal, operating it, and I can raise the money, wedge myself into those deals, get equity and a fee on top of that for some of the active income as you're developing the skill sets to build your own portfolio. At the same time, you can use that to then get into bigger assets. So now when I want to get into RV parks, I help raise money for people who have RV parks, but they have a bottleneck in capital. We can talk about that as well. Same with co-living and portfolios. That's essentially what Jeff and I's structure was this last time. So I really think of things in buckets of deals, money, due diligence. Well, really, I think of it as deals, money, and then operations. But the operations is broken down into due diligence, closing, and then post-closing, right? And that's as simply as I can make it, but it's really deals, money, operations. So it's all you really need to have a successful portfolio. Deals, money, operations. Doesn't have to be your own deals, doesn't have to be your own money. And you don't have to do all the operations, which is pretty sick. I'll expand on all that. That's how you scale. I mean, literally, you start learning how to leverage yourself to focus on the highest dollar tasks and then outsource the things that don't make sense for you. All right, then co-living. Anything else? Co-living, acquisition, systems, capital. Nothing else, guys? You're all good? If I go through all this, we'll crush it? Okay.
So as you said, right now we are at 70 properties, right? And you said like you should not cross 100 properties. So what is your plan? So once you reach around 70, 80, 90, are you planning to move into multifamily or what is your plan with it?
It's what I'm doing now, which is partnering with operators. You shouldn't like solely manage and own yourself independently, like hundreds of single family homes. Because if you develop that skill set, you can then leverage some of your skills, primarily capital raising, and partnering with people, structuring deals to then be able to do more deals with more people, but then offload the operations. When I talk about my org chart, the number one thing I've always focused on, my biggest bottleneck and why I was super depressed and almost retired before I joined Sub 2 with 27 rentals is I was doing all the operations, which means there was a lot of operational things that I wasn't doing, like the bookkeeping and all this stuff that I thought, okay, well, I guess I'll do it and I'll wait, whatever. So then I outsourced a lot of that, and then I kind of did the same thing as I scaled my portfolio substantially, another $8 million in 9 months of acquisitions, and then I outsourced operations more so. And I'll explain kind of what that's looked like all the way up until this journey. Any other questions? That was your question? Oh, why not over 100? Because you only have so much time.
No, that I understand.
You have only so much time, and then as you grow your team, like I don't want to grow a big enough team to manage hundreds of, even over 100 single-family homes. So I'd rather partner with people who will then do the operational work more so, and then have my asset manager oversee certain components of it without me having to be involved with operations as much, besides providing guidance and support.
So you still acquire single family houses, even above 100. The part is the whole operations and everything, you'd keep it aside, and you'd be only involved in the strategic decision to structurize the deal and get a portion of the deal, whereby you do not need to take the headache of maintaining the property or operating the property.
Yeah. So still maintaining equity, because I don't like to connect capital into deals I don't own, because then I'd have a harder time stepping in and solving a problem, right? So that's kind of one of my things. I don't necessarily just connect capital unless I know I can come in and help as needed. One of the best ways to minimize that risk is to partner with people who you are confident in their ability and skills, or at least their integrity, in the sense that if something goes wrong, they'll try to solve that problem, right? Like that's how you minimize a lot of risk if you're partnering with someone. Let's just start with a lot of co-living, I would say. And then we'll talk about cap raising. Then we'll talk about ops. So we talk about co-living data, right? Passive platform is going to have the most data that you can get on the co-living model, the rent by the room model, where to find deals, where are they operating. I don't know if you guys have ever heard of it's like the Starbucks effect, or like if there's like a Whole Foods or a Starbucks, wherever, you're like, okay, they've already done market research to decide they should operate there. Pad Split is the same thing for me in my mindset. Is they spend tons of money, no less than tens of thousands, if not hundreds of thousands, maybe even over $1 million, identifying what market should they expand their business in, right? So I leverage them to help me decide which markets do I want to operate in. And the more data they have in those markets, the better it is for me, because now I have even more data to confirm that they made a good decision, especially if there's a lot of properties, but then a lot of demand, ideally a lot more demand than there are properties, and that the returns are high, like for deals that I'm analyzing, and that the occupancy is also high. That there's properties there that are being filled up, right? That's really the goal. So leveraging PadSplit to help me decide which markets are good. Another thing when I'm deciding what markets I want to buy in, my cheat code is truly PadSplit. It is one of the biggest cheat codes for deciding where to buy in the data. But another thing to understand is that here's like some crazy stat from a Harvard study in 2024. So 50% of people making under $75,000 a year are spending 30% or more on housing and utilities. A third of their income goes towards housing and utilities for those making $75,000 or less. That's those that are making $35 or $37.50 an hour or less. The median household income is around $75,000. Just to go, there's a ton of people who can't afford housing. Secondarily, the 50% of those people are spending over 50% of their income on housing. So there's a huge demand for lower cost housing, and there's really not a lot of options except for some government subsidies, which have massive wait lists. I don't really know what the hell the government's doing about it. They're really not doing much. And interest rates and inflation and all this stuff is making it even worse. Housing prices have skyrocketed. Maybe now it's faltering a bit, but not substantially so to change things, especially because of the interest rates. So housing is more unaffordable than ever, and it's probably not going to change in the near future. So makes this, I guess, fortunately or unfortunately, this is a realistic problem. We don't really think the government can do it. I don't think they can do it. They haven't shown that they can do it before, and they only make most of these things worse. And we don't want like venture capitalists and major corporations to try to solve this problem, because we know how they do it, right? It's a race to the bottom typically. This gives an opportunity for us, more mom and pop style investors, to capitalize on this blue ocean of opportunity for us to build our financial freedom, build a solid foundation, and then do whatever you want with your life. That's kind of the 100 properties. Like if you've got 100 properties, single family homes, you don't have your basic financial needs met, you don't have $5, $10, $20,000 a month coming in to cover your expenses, you probably messed up somewhere. Or you have a lot of super low cash flow, long-term rentals in small markets. So like that's like a good way to decide like maybe I'm just not investing in the right things. Because every property that you add still has time involvement. They're still finding the deal, analyzing the deal. If you're raising the money for the deal, closing on the deal, operating the deal, even if you're not doing every single step of it, there's still time involved with it. You're putting all that time and energy to not well-producing assets. That doesn't make a lot of sense. So if you've done that 100 times, you don't have 10, 20K a month coming in. It's like, what are you doing? Once you have those needs met, I'm all about people pursuing whatever they want in life. For some people, then it is RV parks. For some people, for me, it's like coaching and helping other people. I really genuinely enjoy helping other people on their journey, on their path of financial freedom. For some people, they want to just go travel all the time. They want to do art. They want to raise their family. They want to do whatever you want. That's part of the thing. It's like once you reach financial freedom, it's up to you to decide, do I want $100,000, $500,000 a month? Am I pursuing a $100 million portfolio? Like, what are you pursuing? But the main goal for most people should be to get 5, 10, 20K a month coming in, let's say semi-passively, so then you can actually have options to do whatever you want with your life. Leave your job if you choose to. If something does happen to your employer and they say, hey, you're fired, you've got your needs met, like that's kind of a big part of it. And then you pursue whatever you want. And I think that's why I talk a lot about the accessibility. I think it is more realistic and accessible for most people to get into, let's say, a co-living rental than it is to get into RV parks. There's just a lot of whatever. And that's one example. We can say multifamily and all that as well.
Just one question over there on the pet split data, right? As you said, there are two kind of markets. One is the emerging or evolving market versus stabilized market.
Mm-hmm.
Where do you prefer to invest? Like, is emerging markets a good decision, or a stabilized market where you know that hey, the pet split's already settled up?
I've done both, but for the majority of people starting out, you're not going to have the same resources that I currently do, right? That's the reality of it. If you have more, you have a bigger team, you can dedicate more time and energy to finding tenants directly, as opposed to like leveraging pad split, which that's their main thing, is they don't manage your properties, but they help tenants find your properties, guest communications, owner, like rental collection and payouts. So with that being said, I would recommend the majority to just focus on core markets because it's already a proven market. And there's a lot of data there. When it's a emerging market, that means there's less properties there, means there's less data, which means there's, in theory, more risk. That's why if you go off pad split, it's even more risk because there's even less data. You can still get data from Zillow. Zillow now offers rent by the room rentals. There's data from there. There's platforms like Rentalios and things like that that are catered towards rent by the room for data. But for the majority of people, I recommend if you're starting out and you're just developing this skill set, you're trying to stack a few, focus on these core markets because they've already done all the research for you and they have the data to make the analysis piece less risky, if that helps.
Other way of seeing the same thing, if it is a core market, in that case, your competition also will be high compared to emerging markets, right? So won't that be a challenge? Because let's assume if you're a core market, that there will be a lot of properties which are doing co-living in that market versus an emerging, right?
So you're saying how to know which core markets to choose?
Yeah.
And we crush in Atlanta. We're constantly buying deals in Atlanta. That's the first ever pad split market. So I would say no. Like we rent our properties out. The Atlanta, I'm going to spitball here just roughly, but it's like they have a 90% occupancy within 30 days, something like that. Or no, they have a 90% occupancy, 80% occupied within 30 days. We just added another property in May. From the start to end of May, we had it 100% filled out within 30 days. So we exceeded what they project, and our rental income is all higher than their average projections as well. There might be a lot of properties, but like any investment strategy, it's like, well, yeah, there's a lot of rentals everywhere, right? In theory, but in America, capitalism, are you going to provide a better product than your competition? That's another advantage of pad split because you get to see the other properties that people are listing. And as you've seen certain Airbnbs and like there's a reason why a ton of them fail because they're not doing the things that is needed to get better returns, and that's your operational piece, how you're maximizing your returns. Are you doing the bare minimum? Like pad split allows rooms to be as small as 8 by 10, 80 square feet. That's the minimum. But the smaller your room, the less likely people will rent it out, and the faster they'll turn over because it's just like uncomfortably small. So then are you finding rooms that might be a little bit bigger? Are you building rooms that might be a little bit bigger? Are you not just setting the full bed, but you're going with a queen, which pad split tenants tend to prefer? Queen beds are larger. Are you adding a desk into that room? Are you making it a comfortable space? Are you providing great common area? You don't have to provide great common area amenities per se, but are you like furnishing your kitchens? Do you at least have some character to your properties? Are you taking good photos? It's like the number one way to differentiate from the majority of people. Like I swear to God, I don't know how people are literally taking photos like potatoes. Like I don't know how it's like grainy, sideways. It's like they're not highlighting a key feature of the house. They're not highlighting the rooms. So it's like, can you beat those guys? So even if there is a lot of properties in a market and it's a core market, yes, you have more data, which is the main reason why I like it. But yes, there is competition. Great. Can you beat that competition? And a rule of thumb for me is there's something called diminishing returns. right? I don't know if you're familiar with that concept, but at a certain point, there's no point of improving further because it costs too much input to make it much better. So can you beat the 50%, 60, 70, 80% by providing just some of those basic amenities that I meant? To me, it just seems absolutely basic. Providing decent photos, can you do that and beat the majority of the competition? For sure. At a certain point, though, it's like the 90% or above. Like, are you trying to be the best pad split? You don't have to be the best rent by the room, but can you beat the majority and like exceed that further? That's all you really have to do to really dominate the competition. Because remember, these are averages. It's 50% or less, 50% or more, right? It's skewed a little bit, but 50% or more, 50% or less. Your goal is to be above 50%, ideally in that 60 to 80, maybe up to 90% range, depending on how you're managing your properties. And then like that's another thing, like guest communication and are your tenants rating your properties well? All those things further benefit you, and understanding that it really is a competition between you and others, but the competition, you have a lot of control over that. You have a lot of control of how you are setting up your properties, how you're managing them, all those things, which is nice. That gives us opportunities as not overly passive investors to set up our properties well and to maximize our returns and decrease our vacancy or increase our occupancy by providing a better product than our competition, even if it is a core market. That's why even though Atlanta has the most pad split properties, it is their first and longest market, we tend to still dominate because of that. Does that help? You can do the same thing, and we own properties in non-pad split markets. We own in Savannah, Georgia. There's no pad split there. We own in Port Charlotte, Florida, which is now a market in pad split, but it wasn't when we started. So we are comfortable doing some investing in non-pad split markets, but understand there's a lot of value to be provided as you're starting out because they help you minimize your time on operations, which then if there's less time you're spending on operations, you spend more time on finding more deals, raising more money, which is how you scale your portfolio. But once again, to be financially free, to build wealth, you need to generate cash flow and own your property successfully so you're not losing money each month, so then you can actually build that cash flow and wealth, right? So it's like you need the operations, but you as the visionary, as the business owner, no one can replace you in raising money for your deal. Well, that's not true. But raising money for your deals, it tends to run through you and your credibility, your track record as an operator. And even if you have a connector bringing you capital partners, like it's still you. You're still the product that they're looking at, right? Do they want to invest with you? And the deals, maybe you can have a structure like I do, where I have an underwriter who pre-filters deals and things like that, or you train bird dogs to make sure at least it's within your buy box. And you have an underwriter that's actually analyzing the deal. But at the end of the day, if you're going to invest in a property, you should feel pretty confident in the numbers yourself. Otherwise, you're delegating probably the worst thing you can delegate, which is this a good investment for me and my partners? That's where the real risk is. So it's like you can outsource operations, but you really can't fully outsource deals and money, right? And that's why you need to grow your portfolio, but you need the operations to succeed. Hopefully that helps. And that's why I recommend most people start with pad split as much as possible. Leverage property management, leverage the things I wish I knew in my journey when I was starting out, where I wasn't doing that because I was more focused on saving all of my cash flow by managing my own properties, doing my own renovations, doing my own bookkeeping. When PACE highlighted for me right when I joined Sub 2, or right before I joined Sub 2, I built financial freedom at that point, 26, 27 years old, $7,500 a month. That was more than enough money for me. But what I didn't, it was at the cost of my time freedom. And when we really looked at the numbers, I could have exchanged $750 of that towards property management for my long-term rentals at that point. I was already underwriting for maintenance and all these things and property management. I was just hoarding that cash flow because I was thinking, okay, let me keep all my cash flow. When I can offload, let's say $1,500 of that, free up my time to then be able to focus on deals and money, which is what then allowed me to scale massively, right? Because I focused on the two things that grow my portfolio, started outsourcing the operational pieces. And I'll get a little bit more into that in the org chart structure. Is that good for your question? Okay. I guess I can explain that for the org chart and tie it all in. So my journey simply was in 2018, I got inspired to invest in real estate so I can fast track my path to financial freedom. 2020, after 18 months of learning and analysis, or like develop my buy box, and then I was moving around in the military, then analysis, like I did so much analysis. I analyzed hundreds of properties and didn't pull the trigger on one. I went to a meetup. Thankfully, we're all in this, so you guys are well past that. But I went to a meetup and met people in my local market that were buying the properties that all I was doing was analyzing. They were buying them. I was mad. I wasn't mad at them necessarily. I was mad at myself that that had all these great returns in a spreadsheet, but I had no ownership or cash flow to show for it. So it was frustrating to me, and I gave myself an ultimatum. Either A, I was going to buy the next property, at least make an offer on a property, or I was going to stop playing real estate investor. If I wasn't going to actually do it, I needed to stop playing it because I could just enjoy my life instead. And I'm certain a lot of people, well, I don't know about a lot of people, owners club, but you might be stuck in that phase, and I get it. I was there too. The reality of it was I knew the way I was going to become financially free was through cash flow. To get cash flow, I need to own assets. To own assets, I need to close on properties. To close on properties, I need to put properties under contract. To put properties under contract, I need to analyze deals. And to analyze deals, I need to have deals that fit in that were worth analyzing. I was stopping at step 2, never making an offer, just analyzing. Well, that was the bottleneck. I needed to do the next step from now on, and that was my ultimatum. Either I was going to make an offer on the next deal that I analyzed that made sense, the way these guys all around me were making money, doing the thing that I wish I was doing, but instead I was stopping myself short because I was afraid or I didn't know it was possible. And a first-generation American, come from a lot of poverty, fear of failure, fear of success, really bad mindset with money, all these things, whatever, made me very afraid to actually do the offer because then it was going to get real if they accepted my offer. And I understand it was a mindset thing. Thankfully, I forced myself because of the ultimatum. I'm not saying you should give yourself an ultimatum, but that really helped me. So that being said, I got my first property, a duplex, a 2-unit, and that's all I really needed, that proof of concept to say, okay, I'm going to do this damn thing. Because now I can model my numbers out and say, okay, I am fast-tracking my path to financial freedom, which was going to take 40 years. I just cut 5 years off of that. It's a 2-unit. I live in 1 unit. I rent out the other. I'm living rent-free. Awesome. I did the same thing with a 4-unit the next year, started learning off-market deal finding, wholesaling, seller financing, invested in my first education for seller financing, structured rental cabins, the Morby method route, and at that point did one more house hack with a multi-unit. That was 2020 to 2022. At that point, like I said, around $7,500 a month cash flow, but I was doing every single piece of operations, and I hate operations. I genuinely hate operations. I don't like to communicate with tenants. I don't like to review and set up leases. I don't like to, hey, you didn't pay your rent yet. Here's a late, you need to do a late fee, and why aren't you paying? And all. I don't want to do any of that stuff. I hate bookkeeping. I hate tax stuff, but I was doing it because I'm like, I'm going to keep all my money that I just learned how to accumulate, and it was Pace that really helped me understand if I offloaded the $1,500 a month that I was underwriting for, that I was going to pay property management, that I was going to do maintenance, if I just offloaded that, in theory, I would get way more time freedom back. Even if I didn't do anything else, I'd get more time freedom back. I'd enjoy the process more. The reason why I didn't want to grow my portfolio at that point anymore is because I didn't want more work. The type of work, I like work, but I don't like operational work. So I didn't want to grow a portfolio, buy more deals that were then work that I did not want to do more of, essentially. I didn't want to buy another property that I have to operate, bookkeep, all that stuff. So then that was the first thing that opened my eyes, was like, okay, well, my first team was, okay, let me outsource property management. That was the first member on my team. Okay, well, I hate bookkeeping. Let me find a bookkeeper. Let me, instead of trying to do all the maintenance work myself, let me outsource that to someone who knows what they're doing and free up my time. But not only did I went from $7,500 a month, let's say $6,000 a month of cash flow. What I really did was I freed up my time to then focus on the parts of my business I enjoyed. Deals and eventually raising money. Because that would then allow me to grow my portfolio. So that's the idea. This is anything. Like, you're probably going to be like super slow. You might not do anything for a while like I did, like 18 months of this. Like, you have your learning phase. So this is my 18 months. And then I started growing my portfolio. Let's go more flat. And then I got a little more confidence, so I started growing a little bit more. But then the reality of it is, but then I got stuck here. I could have plateaued and kept my 7,500. Let's say this is like money, I guess. So we'll say this is 0. I'm freestyling this chart. I've never done this chart like this. But let's say money is the y-axis. The x-axis is time and some key events through there. So then the reality of it is, I could have either plateaued, right? I could have plateaued here, and that's the trajectory I was on. I was going to commit at 27 years old to not doing any more of this because I created a business that I did not enjoy. I definitely didn't want to continue scaling, but instead, because of the right mentorship, the right guidance and education, I learned, well, let's offload this stuff. It's going to cost me money, but then I can start to climb back again, right? And this was PMs, handyman, bookkeeper, some of the more obvious things. But because I had all my mindset issues once again, I just made this damn money. Why would I give anyone else that money? I know I said on a spreadsheet I would. That's my money. I don't want to give that up to someone. I didn't value my time. Actually, Pace quite literally told me I created a shitty job that wasn't even paying me that much money, that I hated to go to. So I'm an engineer by trade, and even though I was military and then government, I made decent amount of money. Like, it wasn't phenomenal, but it was, I got over 6 figures, so that was nice. Well, after the military. This $1,500 was killing me. Quite literally, I hated it. I was depressed. I literally hated this phase of my journey. And all I had to do was just give some of that up to then free up my time to then go do better things. This is sad me. This is happy me. Right? So, like, even if I just outfloated it and I could be happy with 6,000, as opposed to staying flat and being very, is this helpful? Should I keep going down this road? Okay. Good. I figured, because I never know, right? Because we're owners club. But, so sad face, right? Like, I could have kept it and I could have been really sad. But instead what I did was I invested in education. I learned not only I knew some seller financing and all that, but I invested in stuff too. Thankfully, we're in the best community there literally is in real estate. There's like nothing like it. I have my own course, I have my own education, but it's not this, right? It's very tactical, step by step, how to do a lot of stuff, but it's not what step 2 is. It's not Owners Club, it's not Pace. I'm not Pace, and I don't think I have the energy that Pace does. And he's got a lot of experience, right? That's played a massive role in my journey. But I took this time as a worker, and most of us are workers and we're investing. I invested in my education to get more. This was 2022, the market was shifting too. I knew I couldn't just buy traditional deals indefinitely because the interest rates were going to price most things out. So I invested to learn more skill sets. Primarily, it was, so sub 2, it was creative financing, and that's deals, right? I lumped that into deals and structuring, capital raising, and then I'll just say mindset that led into ops. And so I took my time and energy and focused on, if I was able to free up my energy here, I could buy more properties. Well, at this point, me and a business partner focused on deals and capital raising, which is a way better use of my time than just bookkeeping and things I hate, because I enjoy that part. I'm a relational person and a numbers person, so I like to talk to people, I like to analyze deals, I like to structure deals. So I took that time and energy and did this, and that actually allowed me to scale. It's actually more like this, right? So I got 2 million here. In 1 year, I got 9 months, another 8 million. I had another 8 million in my portfolio in another 9 months, because then I focus on growing my business. Well, unfortunately, I made the same mistake, where my business partner and I were still doing the operation. I knew to have a bookkeeper this time, so we did that, but we were managing a lot of our own assets ourselves. We were overseeing the renovations and all that. As you're adding a lot of properties, there are bottlenecks to that, and that was once again taking away my time and energy, being able to find more deals and raise more money. And so what I had to do, we went down even further, because what we did was we hired an operator. We hired an operator to help us with the due diligence phase, right? Hey, we don't need to get these insurance quotes. You can do that. Go talk to a variety of contractors. You ask, how do I feel comfortable leveraging out-of-state contractors? Because I primarily do things through referrals. I am part of a community like you all, where people are doing every type of deal in every single market you can imagine, especially co-living markets, because they're not 100-person town in Missouri or whatever, right? We're talking like big markets. There's lots of investors in every market that we're operating in. We can always tap into our community and their referrals and their resources. If you come from the bigger pockets world, where everyone was hoarding everything and they don't share and refer and help you out necessarily, that's not the case with our community. Our community is so giving, so sharing, so helpful. So that's why I feel comfortable with it. I primarily get referrals from people who have already used those contractors. Does it make it still difficult? And you still have to understand how to oversee contractors and how to pay them a certain portion up front and then only pay them after they send you photos of work that is done, especially if you're doing, like, let's say a hard money loan. You don't always have to do a hard money loan, but if you're doing a hard money loan, you need those photos, then submit draws to the hard money lender, then get the money back. Like, you validate the work that they've done, you pay them after the fact. You have to pay them a certain amount to get started up and for materials, and then you only pay them as they complete work with photos and videos, and you can send third-party people. Cleaners, realtors, maybe the wholesaler that if they brought you a deal and they're in that market, sub 2 community members, plenty of people. You can pay $50 to $100 to go check out your property, take some third-party photos and videos, because we have had contractors send us photos and videos that are very perfectly positioned. They know what they're showing and they know what they're not showing. So then how do you confirm that? If it's a referral and you're still not comfortable with it, send other people there. It's more of a mindset thing than it is anything else, because there's more than enough people out there. You can go on a variety of platforms to just hire someone to go check out a property shortly, right? So that's one of the ways. Does that help? Do you want me to expand further?
No.
It's the way you structure it in your contract. You incentivize them by paying them once the work is completed. You can validate the work they're doing through third parties and photos and videos. And if they're sending you shit and hiding stuff, but your third party is showing you stuff and saying, hey, this seems like a concern, that's a really good sign that that contractor does some shady shit. You maybe don't want to work with them. Even if they were a referral. A referral does not mean you have the luxury of not validating their work. It just means that at least someone else went through them and has something good to say, as opposed to the ocean of potential people that you could be using. Because there are a lot of scummy contractors, especially when you're out of state. And honestly, it tends to be the smaller the market, it tends to be the worst contractors for us out-of-state investors. Why? Because they don't really support us out-of-state investors in their small markets. They know it would be more challenging for us to do something about it there, we probably won't repeat a lot of business with them, as opposed to in Atlanta. I'm just saying Atlanta over and over because I do a lot of co-living there. Okay. Sorry, but Charlotte, whatever, because they want your repeat business and they want your referrals to other investors as well. So you structure your contract to them well, you structure the payout structure with them that requires validity, verification, ideally third-party verification, before you pay them out for the work that they completed, and you highlight the fact that you can get them so much more business depending on how successful that is. Whether it's through you and you plan on doing many more of these deals with them, or through referrals that you can share with them. Go for it, James.
Okay, so I want you to back up just slightly.
Please.
in the sequence of events, right? So when you were starting out, right, you're in San Diego, right? You do your first deal in Atlanta. You don't know anybody. You got your private money people that you're talking to, presumably before the deal, but you're getting ready to go out into a foreign market with somebody else's money. How did you step over that hurdle of making the money people feel comfortable with you stepping into a foreign market, and then you're going to have carrying costs, right? So your first deal that you did out of state, can you describe both the private money process that you went through, and you kind of just did the contractor aspect of it, but at some point in time you got somebody else's money, you've got carrying costs and time, right? And you've got your contractor that you're trying to all coordinate into getting you up and running. Can you describe that middle part is like
Yeah, so we'll talk
vacant from anybody
this
else?
$8 million. We'll talk about the first property I bought in March of 2023 out of state in the first true capital raise that I did for that. So this property right here, this was a pre-foreclosure in Beaufort, South Carolina. This property was one where the veteran was way behind on payments, and he had a decent amount of equity, but he was going to lose everything and the ability to use his VA loan, right? So creative financing was able to solve that problem, get us some instant equity. And what we did with this property, this is actually my first co-living, but not in the sense of the way I do co-living now. This was a sober living home. We found Oxford Homes, it's a common sober living home operator. We said, hey, we're looking at a property here. Would this be something that you want to rent out? So first of all, it was a great deal. It was a great deal nonetheless. It could have been rented as a cash flow neutral long-term rental. Would not have been a great long-term rental, but we weren't going to lose money as a long-term rental. We would have, if we lost it, it was minimal loss as a long-term rental, but it had a huge upside as a sober living home, as a co-living, right? Just the sober living is a subsection of that.
Just on that note, how did sober living even come to mind for you?
Okay, so how do we know sober living? How did sober living come to mind to us? So we're in sub 2. We heard a lot about it. We said, okay, everyone has probably heard of Oxford Homes through sub 2 in general, right? Like you've heard of them and you've heard Oxford Homes through sub 2. So the idea for that was this property wouldn't make a lot of sense as a long-term rental. It wasn't worth any investment as a long-term rental necessarily. It had upside because of the size, and it had a lot of equity. So it was like, well, do we fix and flip this? Do we wholesale this to a fix and flipper? Or if we're going to own it, what strategies could potentially make sense? We didn't want to go short-term rental in that market, so that was out the window. In that same sense, it was a larger property. So mid-term rental didn't really make a lot of sense because the best mid-term rentals tend to be smaller with a high turnover rate, like a lot of transitory people coming into that market, the healthcare, military. It was military, but it was too big of a property. Like there's not a lot of people who need midterm rentals for like 4 or 5 bedroom homes. So filtering out what didn't work was a big part. That's why my super investors thing that I have, my own community, it's all about like identifying deals and what makes the most sense for them and understanding what types of properties make sense for a strategy. And it's going through this checklist. Same thing with when you're trying to acquire a deal. How do you know what type of deal to acquire? What is the best structure? Then what strategies make sense for this property? Okay, we could flip it, wholesale it. It didn't make sense for other strategies like long-term, mid-term, short-term. What else could work? We continued learning. Co-living, sober living. Okay, well, let's reach out to this company we were talking about, Oxford Homes. Big house. Let's reach out to them. They said, hey, we will pay you this much if we can get this many rooms. Could we add another 2 rooms in this house? Yeah. That's how it happened. Finding a great deal, understanding that it may or may not work with a certain structure, but there was equity, so there was potential to at least flip it at the worst case scenario in that specific deal. And then learning, if what I learned after my Morby method in 2021, which I did not know. I mean, I say Morby method now, like I didn't even know what that was. I didn't even know it was possible. Sometimes it's better to find great deals and take action and then figure it out along the way. For example, for that Morby method, I needed $130,000, even though I structured it as a deal between the commercial lender, 80% loan, the seller, he could cover 40% from his equity, but he needed 20% of that, so he could give me 20%. So my money in is 0. Between the seller and the bank and what the seller wanted to accomplish, I could buy this deal using no amount of money. First of all, I didn't know Morby method. I've never done a commercial loan up to that point. I didn't own rental cabins before that. I never even did seller financing up to that point. It was my first seller financing deal. I didn't know they could combine the two things, and you really kind of can't, but you kind of can, obviously, because people do Morby methods. I didn't know anyone who's done things like that. But when you find a great deal and it starts to make sense, you start noodling it and it starts to make some sense for you, and there seems to be a possibility, it's better to move forward and then figure it out along the way. Because if I didn't, then I wouldn't have had that deal. I wouldn't have had this deal and many more deals, because we are the type of people typically in these rooms that are willing to invest our time, money, and energy into learning and executing, and that means you don't always know the next step. You have to be comfortable understanding as you're going to scale and grow. You don't always know the next step. That's why people sometimes join my community, so they can have a guidance on what the next steps look like, more so because they understand the process through my own experience. But at the same time, you will not always know the next step of what you have to do. If you find a great opportunity, you start figuring out along the way. Does that help?
Oh, yeah.
Do you want me to get any more into the weeds of that?
No.
Okay, but yeah, sober living, started looking at that, co-living, all that stuff. So that was my first official co-living. Give you guys a little insight. As a broke college kid in La Jolla, I went to UC San Diego. It's located in La Jolla, like one of the most expensive markets there is. Rent was ridiculously expensive, both on campus and off campus. My parents at that point were in a position in which they were in the position where I barely got virtually no financial aid, but they had no money to give me. That like worst position between FAFSA and all that. I got scholarships. I was very academically inclined. I put in a lot of work. So I got some scholarships, but I had to work. Before my first day in college, I was on campus working at the dining hall, making minimum wage to help support my education while I was at school. All that being said is I could not afford housing. So what did I do? My first experience in co-living was renting a property and renting it out by the room to others. So that was my first unofficial experience in co-living without knowing what I was doing. I just knew, hey, I can arbitrage this house. I didn't know the terms. I didn't know everything. Once again, figuring out, okay, this will help me. How can I do that? The next time was when I did my first house hack, renting out the second unit by the room to military members, because I knew they were already doing that on base. They want to be off base so they can keep their housing allowance, and the less they pay, the more they get to keep in their pocket. So that was my second unofficial co-living thing that I've done. But this was my first ever official co-living, which was the sober living route, and this was hiring an operator, like paying Oxford Homes renting it out for me, and they operate as a co-living property. And then the more so what I do now, which is like pretty all-inclusive to everyone. I don't specialize in just sober living, veterans, whatever. It's like younger professionals. It's not even younger. Literally anyone and everyone that qualifies for that house is more than welcome to stay there. I'm not going to filter them out. They can decide if it's the right house for them or not, because for me, it's all about scalability. The more niche you get, sure, the more cash flow you can in theory get. Same concept. the more operational I get, the more operations I do, the more cash flow I get to keep, but that prevents me from making more cash flow by spending my time and energy on buying more assets. That it's all a trade-off, right? And so that was the trade-off in that scenario. That's why we offloaded that, and that's why I'm not very niched down into one like tenant category where some people are like, all I do is veterans, I work with agencies and all that. I don't do any of that because my time and energy is better spent. It's not spent on maximizing cash flow for that one deal. It's spent on finding more great investment opportunities to scale my portfolio, because that $200 extra I can make, I can go get another $1,000 on the next deal. Not only that, I can get 5 times that in ownership benefits on those deals as well. That's kind of where my brain is at now. And it has been since 2023, primarily with that mindset. And that really helped me scale a lot. Is that it on that? Should I keep going down this track? Okay. So you want to know, so then like here, it was, okay. So like here, we were sometimes doing our own TC work. Sometimes we were offloading TC. We didn't like, why would we spend money on this? We could do it ourselves, whatever. Oh wait, James, you had a question.
Well, yeah, the private money on that deal.
On this first deal, perfect. Okay, so we had that deal. Well, in that instance, it was a little more straightforward because now we already talked to Oxford Homes, so we knew what the returns were going to look like.
Well, hang on. So did you have the money lined up before you talked to Oxford Homes, or did you talk to Oxford Homes after you evaluated the deal and you said it was kind of a flat line? Let's see if we can juice it up a little bit. So you found Oxford, and then you went looking for the money?
Yes, because I did what Pace said not to today. I thought I could raise money just because I found a good deal. I learned the hard way that that's possible, but it's a lot freaking harder, and you're probably going to have to give up more. Doesn't mean it's impossible, but it is much harder if you're just focused on deals before you raise money. But if you are focused on raising money ever before you find deals, your life is at a massive advantage. In every single deal that I've done since then, I'm proactively developing relationships way before I ever need that money. That's why I like to caveat with people. I've deployed around $5 million to build my $20+ million portfolio, but I've raised over $10 million. I still have a major runway of capital partners that have soft committed on to invest with me that I haven't even tapped into yet, because I'd rather be in this position and unfortunately not have deals for them than be in the opposite where I'm scrambling to try to find money. So in this instance, I did not do that because I didn't think I had to. All I had to do was find a great deal. I'd raise the money. We'd split it. We'd be great. Well, that wasn't the case. It was around a $50,000 capital raise. This property had a lot of equity already, so it was like already a no-brainer. It wasn't just cash flow and cash on cash return. There was also instant equity on this deal. Would allow us to exit. We only had to do very minor remodel on it to then add the 2 bedrooms, so it wasn't a huge capital raise on this one. We did the direct acquisitions on this one, so it was very little acquisition cost as well. And that $50,000 was so freaking hard to raise, regardless of a great deal. Regardless, even though I had some properties myself, because I didn't do the most important part, which is build relationships with people before I needed their capital. I thought my value to them was a deal. That's part of it, right? There's a lot of people who have money that want to deploy them into deals, but it's that funnel. And I talk about this, where it's like views. You need people to know who you are. They cannot invest with you unless they know who you are. They need to know somewhat who you are to some extent before they could even ever consider investing with you. Fractional has like somewhat democratized that a little bit, but nonetheless, it's usually they need to know who you are. Well, they need to know who you are before they even join a fractional as well. So like, they need to know who you are. You need to nurture them, like Pace said, build some form of relationship. For me, initially, it was getting on Zoom calls and all that kind of stuff and connecting, understanding, make sure there was alignment with what we're doing, what we're offering, with what they're trying to do, and it makes sense for them. And then I can continue providing value. And then I don't know what his last part was, but the invitation and the bridge to the actual deal, right? But I didn't think like that. I thought the only value I needed to provide was a deal. I completely shifted that as a learning lesson from there, and Pace saying if he was ever to learn anything, it was the ability to raise capital. Like if he was to go back and ever focus on one skill, it would have been raising capital. But the first deal was very hard to raise, and it was a great deal because what I didn't do is I didn't do my homework in raising or developing relationships with potential capital partners. I took it for granted and assumed that people would want to do deals with me just because I had a deal, regardless of the fact that, yeah, I mean, that's what I thought. I just thought that's all you need to do. So then I shifted my mindset, and I'm constantly raising capital all the time with everything that I'm doing by providing as much value, getting people to know who I am. At minimum, you got to like share who you are. Like, people can't invest with you unless they know who you are, and they have a lower likelihood of investing with you unless they have a relationship with you. And the more value you provide to someone, the more value they want to provide back to you in return. So it's developing that whole process over time, understanding that I didn't do that the first time, and it made it way harder because I didn't think I had to. But at the same time, I put it under contract and figured I would figure it out nonetheless.
One question on the same thing, though you said it was hard. did you have to par away with more equity
Huh?
versus?
Yeah, so that was the most equity I've ever given up. So it was a 50-50 split. But this had not just high cash flow, high cash and cash return. It also had equity as well built into the deal because we bought it under market. The debt was significantly lower than the property value. We actually since have sold that property. Great deal though, nonetheless. We just cashed out the equity. That's going to tie into the other question that was asked.
You have to par away with more equity because
Yes. Okay, so when you understand that the way you raise money in the beginning is not the way you're going to raise money in the future. I don't know if you guys have kept up with me a little bit recently. I raised the majority of my money very privately, my capital partners. I send them, here's some deals that I have, you want to do these deals? But I've recently raised over $1.2 million on fractional. So people have publicly seen me raise a lot of money. I've raised $800,000 in 72 hours. On Jeff and I's deal, we raised another $450,000 in another 72 hours. So over $1.2 million in 2 3-day increments. But it was so hard to raise my first $50,000. Understanding that it's harder in the beginning. You're going to probably give up more in the beginning because you are a higher risk because you have less experience. You have less performance or track record, if any at all. But it doesn't have to be that way forever. As you grow and develop your skill sets, build more relationships, get more eyeballs on you, get more views, show people who you are, what you're doing, you find more people more in alignment, it becomes easier and faster to raise the money. And in theory, you get to offer less in return because you're a lower risk investment. Then it's like why bonds return 3, 4, 5% because it's a lower risk than the stock market, which offers 10. It's like a risk to reward relationship. It's like PMLs, right? It's like there's the different PML, different assets that people are lending on offer different returns primarily because of the risk involved.
Similar to value of a brand name, right? So now you have a brand where you can command based upon that hey, because I am performing and I can show this thing, you can par away with less equity.
Yeah, and a big part was I got very phenomenal at not just analyzing deals to buy, but then structuring the presentation for my capital raises in such a way that highlights all the key benefits, not just the cash flow and cash return. So if there's equity, I'm making sure it's being accounted in their overall return on investment. Well, there's appreciation benefits as a co-owner for private equity partnerships that they're going to take part in. There's debt paydown. Well, I'm going to make sure to do the work to know what their debt paydown is going to be, and so they understand how that looks in their return on investment. Actually, this works really well with you. The tax benefits, well, if they get to capitalize on those tax benefits, it's really important to structure your deals in such a way that makes a lot of sense and it's almost a no-brainer for cap partners and highlight all the various benefits of the investment opportunity, not shortchange yourself. Because if you shortchange yourself, you're going to offer more because they're going to think they're going to get less returns. At the same time, I highly advocate to be more conservative when it comes to your cash flow analysis. Even my appreciation analysis, instead of saying 5%, right, I'm typically at 3%, at most 4%, depending on the market. So it's under-promising, over-delivering is the goal. Does it always pan out that way? Of course not. But it's highlighting all the investment benefits in this deal. So that's like how it makes it easier to raise the money and you present it in such a format that people can easily understand it and make a good investment decision. This was another thing I saw, Sam Singh was talking about. I don't know if you guys know Sam Singh, he's awesome. He's talking about wholesaling. Like a lot of wholesalers don't get their deals done because they make the buyer have to claw so much information from them. It's like I have to ask question after question after question instead of easily presenting the deal and all the information that I need, whether it's good or bad, let me make the decision without having to ask you a million questions. Otherwise, I assume you're hiding stuff or you're incompetent in your ability to present the data for that deal. Same situation with account partners. Some people say, hey, I'm looking for $50,000, 12% return. Or hey, I'm doing a 50-50 split for $40,000 with little to no information. Well, I'm giving you all the damn information on our deal so you can make that decision. First of all, it's a strategy for myself to filter out the wrong people because they have the information. They can say, do I want to do this or not, without asking me a million questions because that's my time. I don't want to waste my time if it's the wrong person. Let them decide if it's the right person or if it's the right investment for them or not. But then it's making it almost a no-brainer for them on all the questions I anticipate they will have. Here's the property. Here's who I am. Here's the current condition. Here's how we're acquiring it. Here's where the money's going to. Here's our plan for it. We're converting to CoLiving. We're doing short-term. Here's what we're planning on doing. Here's some comps. All that stuff, I put it in my presentations so that they can answer the majority of their questions and decide if it's a good deal for them or not. The more of that you do, the more of your time that you save, and that helps people who want to invest with you do so more easily.
One question on this benefit side. Normally we also provide the taxation benefits, but not all people can claim the tax. Let's assume if they are working community, right? Like husband and wife both are working, they may not be able to claim the tax benefits, right? How do you promote that tax benefit for those cases?
You showcase the tax benefits, and it's up to them to decide if they're in a position in which they can take advantage of that or not. So that's why I talk a lot about cash flow and cash on cash return, right? That is quantifying the return, their money invested, and what their cash flow they're returning from that. Then the return on investment, right? It's a distinct thing. I'm not lumping it into one. It's two different metrics for them. Their total return divided by their entry is their return on investment, and that total return that quantifies the cash flow plus the appreciation plus the debt pay down plus the tax benefits. If they don't get the tax benefits, they need to know that for themselves. If they have questions about that, I'm more than happy to say, hey, depending on the situation, this is what I think, but you need to talk to your own CPA, because I'm not your CPA. I'm not here to provide tax advice. You need to know if it's the right position for you or not. Talk to your CPA who understands the situation much better than I do. So sharing that information, and I do it in two different metrics: cash flow / cash on cash return, and then total return and total return on investment. So you're detaching the two, and then they see it all laid out really easily. I have this awesome calculator that does that automatically. Yeah, I have a free one too, which is awesome. It helps you analyze deals all different types of ways, but the automated capital raising piece is a separate thing.
Are you doing cost tags on your co-living stuff?
It depends.
Depends on what?
It depends on if we decide to and if it makes sense for our partners. So for me, I don't need to do cost tags because I already have so much tax benefit. Like, I don't do a cost tag on every single property that I buy. Here with me. Cost segregation is a way to maximize your tax returns. It's a way to maximize your returns. It's a way to maximize your tax benefits on an investment. Here. So the way you get tax benefits on a real estate property is the property, the IRS says, this property, essentially whatever it's worth, the property, not the land, so it's not just your purchase price, it's usually 80% of your purchase price, that can be depreciated over 27.5 years. So let's say it's $1 million, 80% of that is $800,000. $800,000, well, that's gonna be hard math, but $800,000 divided by 27.5 is what you can take as a tax benefit for your property. That plus your interest payments. So one of the things we talk about a lot is you're paying down, your tenants are paying you, which is you're using to pay down the mortgage. The mortgage principal, if it's $100,000, your full monthly payment is not paying down that mortgage every single month, right? There's some going to principal, which is paying down that debt, and there's some going towards interest. Well, the interest in theory is wasted, but it's actually also a tax benefit. You get to at least use that as a tax benefit. Those interest payments count towards tax benefits. A cost segregation then allows you, if you are renovating the property or furnishing the property, you can then have more tax benefits on that property, and you can even, depending on the strategy, do bonus or accelerated depreciation. Instead of depreciating and getting taxes for 27.5 years, 800,000 divided by 27.5 and getting that for 27.5 years, you can actually get that all in 5 years. So you can massively increase your tax benefits for those 5 years, but that's it. It stops at that point. Once you have a lot of assets, you will tend to have way more tax benefits than you will ever need to capitalize on. And understand that the tax benefits that you take, the depreciation that you take, needs to get paid off at the sale of your property. I'm not going to get into the weeds of that. I'm not a CPA, but that needs to be paid back in some sense. The capital gains that you will pay on the sale, in theory, capital gains are, I'm getting really in the weeds. It's like the property, the sale price minus your purchase price, we'll say. That's what we'll say, okay, is the capital gain. So if you bought it for $1 million, you're selling it for 1.2, that $200,000 is your capital gains that you'll pay tax on. But if the property is being depreciated, your purchase price is lower now. So instead of $1 million, let's say it's $800,000. So now your capital gains is 1.2 minus 800, so $400,000. So you're gonna have to pay that back at some point in the future. That's why a lot of people do a 1031 exchange, and they leverage that to tax-free buy another larger, typically, asset to then delay those tax benefits or delay that tax impact on the capital gains. Do not want to get you far in the weeds. But the more you do that, if you're...
You brought up, because your private money lenders are getting a tax advantage, your whole cost of ownership, right, benefit that you were talking about. I was just curious if you were cost segging, and clearly, from a math standpoint, if you're spreading your cost segregation over to your PMLs and they're getting out in 5 years or whatever, right, then that becomes kind of a really wicked accounting nightmare.
Yes, and that's where it's really important, like capital partnerships. Like I said, it's all about views, building trust with them, and making sure you have alignment with them. So there are a variety of types of investors. There's tons of investors that will do PML at different rates for different structures, variety of primary partners that are looking for different things. So if your demographic that you're primarily raising money from are people that are high income earners that can at the same time take advantage of the tax benefits associated with real estate, well, they're going to probably care a lot more for those tax benefits. So you can offer them less cash flow, even less ownership, and maximize their tax benefits on those investments because they know how much money they're saving. That's how you're offering that deal to them, right? This is where it's really important to understand deal analysis and what are your capital partners looking for so that you can align the deals with them. I don't really do that approach. I don't necessarily raise money from people that are looking for high tax benefits because I also like the taxes. I pretty much structure my stuff equally. If it's a 50-50 split, 70-30 split, whatever, like the cash flow and all the ownership benefits are split based on our ownership split. I don't really pull any of those individual levers unless it made sense to do so, but it doesn't really because most people that I'm raising money from are other investors who want to be part of these deals and they're looking at everything, especially the cash flow and cash return, not just the taxes. But I know plenty of people that solely buy short-term rentals. This is how we sold one of our first co-living properties that wasn't in the long term a great deal for us, the way it was set up. Even though it was an Atlanta property, I could talk about that too in here. What really got me all in on co-living, but they bought it because what they did was they're willing to pay the price that we wanted for it higher than the price that we paid even a year ago. We made a profit on that thing, got rid of a property that didn't make sense for our portfolio because the way we were looking at it was cash flow and cash on cash return, same with our capital partners. The way they were looking at it is we're going to take this property, it's already renovated and furnished. What we're going to do is do a cost egg, and their capital partners that they were getting money from, all they cared about was tax benefits. Primarily real estate real estate agents who are real estate professionals who all they want to do is minimize their tax burden. So for them, that deal made a lot of sense because they knew who their capital partners were and they structured the deal to maximize that. But that's why the people who bought the deal, they keep the majority of ownership and cash flow, but they give up the majority of tax benefits. So that's why it's so important to understand deal structure and its various components, and then make sure that you're showcasing the right things that are in alignment with your capital partners. That's why you gotta be pretty knowledgeable about this stuff, right? And it's where deal analysis is huge. I mean, you can go back, Pace and I go back and forth, because I'm more analytical in that sense. And he's like, I've never analyzed a deal in my life. I just have a good hunch for deals. I'm not that case. I've analyzed thousands of deals that I never bought, right? Because that's the way I work. It's just the way I think, and I don't want to take unnecessary risk if I don't have to. Did I answer? We're good with these?
Yeah.
Taxes, cost seg, holy crap. This is why Binal, I sometimes get a little upset they put me in this, like Binal, because it's literally everything, and I understand, yes, that's like one. I'm grateful that they think I can talk about everything, so I appreciate that. So, gratitude. These are problems I wish I had, or these are problems I wanted a year or two ago. So here we are. This is awesome. All right. We talked about this one. And then so we were doing like the TC work for some of our deals. We weren't using, sometimes we'd set up our own LLCs instead of paying Prime or whoever to set up the LLC. Then we'd get the properties and we would be the ones to get if we're gonna short-term, co-living, whatever, we're gonna furnish it, we'd be the ones to create our furnishing list. We would do all the operational work, all that stuff. So what we realized is, well, now we're spending a lot, and we were pretty much doing a lot of in-house management because we thought that was the best thing to do, especially with short-term rentals, because instead of outsourcing 25% of our expenses to someone else, we could just keep that, and that's additional cash flow in our business. There's two of us now. We could do that. Well, in hindsight, that was only sustainable for so long, and we got very overwhelmed by December 23. And so what we did was we hired an operator and started outsourcing things more intentionally. Like, we don't need to do our own TC work. It's stupid. First of all, it's risky. Like, just have the people, like, even if we do 10 a year, 10 properties a year, 20 properties a year, I still don't know nearly as much as a TC who's doing multiple different people, multiple different stuff. Like, that's literally what they're spending all their time and energy on. Great person to pay $1,500 more. Especially if you're raising the money, that $1,500 is like virtually insignificant in the overall deal analysis. It's not that there isn't an impact, but it's almost minuscule. And if your goal is to scale and to do things with lower risk, well, having the right people on your team doing those things, that's the way to do it. Same with like $500 to set up an LLC or $450 or whatever they charge. It's better to just outsource that thing than us doing it, based on time, risk, all those things. And then same with property management. So we started outsourcing some property management, and then I'll talk about this journey. So we started outsourcing a bunch of stuff, and then we hired an operator. We took our cash flow and said we're going to reinvest it back into the business. Instead of living on the new cash flow, we're going to do that. We're going to bring in someone else who's going to help us with operations. So we paid her commission only initially, and then we paid her salary with bonuses in the future to basically say, okay, you're going to do a lot of this operational stuff for us, She had good background experience. We trained her into the role, what we wanted her to do, and that freed up our time to then focus on more deals and money and ensure the operations were working as they should. And then that allowed my business partner and I have split since and all this, but to scale massively again over the next 12 months. Because we outsourced the things that were bottlenecking our business that was not the highest and best use of our time, because A, there were better service providers that could do the work than we could, and they obviously, well, I assume they enjoy it because they keep doing it, and I don't want to do it, so obviously they enjoy it more than I do. And B, hiring someone with it, because you can't outsource necessarily everything, right? So there's certain things you have to bring into your team and then delegate to the right people, and that was that big shift here with an operations manager to then have her get those quotes and budgets and oversee certain things. She has more of a design and contractor like experience. That's really kind of what she does, and she oversaw, well, both global, but also like, let's say out of market, out of state renovations, all that. She would fly in and visit projects, but she wasn't there the whole time, right? So that made a lot of sense for us to outsource to her, and then that allowed us to focus more on money and deals again, which then allowed us to scale again. So the idea is you're going to be fairly flat when you start, typically. Some people hit the ground running, right? The less mindset issues you have, the more time you have, the more money you have, the more your active income is secure, the larger the portfolio. Well, we'll say when you're starting out, you don't have a portfolio, but the more that you have, the faster and lower risk you are to start your journey. All those are advantages when you're starting your journey. But a lot of people, you have to learn and figure things out for a little bit, and then you start scaling, and this is an inevitability of scaling. As you scale, there's going to be a certain point in which you are unable to do everything yourself and continue growing. Either A, you will hate the work that you're doing. It'd be rare for someone to love every single part of the real estate transaction, like every single part of it. And usually, yeah, so outsource things to service providers that do this thing every day, even though there's a cost associated with it. That's the cost of doing business. And that cost, that $500, allows me to then find potentially that one capital partner that I wouldn't have otherwise if I was spending all my time doing all my own LLCs or whatever. It's all a trade-off. And for me, it's the trade-off of what are the things that only I can do for our business that someone else necessarily can't, right? Money and deals, like deciding the deals that we're going to buy and raising the money for our business is at the highest and best use of my time, as opposed to all the operational things that could be delegated to people who do it better for relatively low cost, especially when you're raising money. If you're not raising money, it's still more worthwhile if your goal is to scale or if you hate that work. This is good for the journey? Okay, and then what I've been doing, let me finish this up real fast. So what I've been doing since there is, once again, I slow down. Well, actually, I kind of slowed down. I didn't go down. I slowed down. I started understanding what, like, so pace time, right? Like, this was in 2023 as well. So first, 2022, biggest lesson, right? So 22, if you want lessons, let's say, don't build a job you hate, right? And then that equaled more time. Because I was no longer doing the things that I didn't enjoy, and I was offloading those pieces of the business, so I had more time to then be able to do better things. Well, in 2023, two of the key lessons that I learned, and please, depending on how I'm in step 2 and all that, like, understand that when Pace talks to someone, he's talking to everyone. Not everything is always applicable to everyone, but if you are waiting for him to specifically give you advice, you're doing it wrong. If I had to wait for Pace to specifically give me advice, I would have nearly nothing what I have. A lot of the benefits I've gotten from Pace have not been directly to me. They've been to other people I've listened and said, I can apply that principle. I can apply that lesson to my own business. This one was very applicable to me. This was even before I joined Sub 2. I met him in San Diego at a meetup, and then he was going to come to Bigger Pockets. And I was like, okay, yes. And that's how I decided to join Sub 2. This is my first lesson he directly told me. Mostly everything else that he's taught me have been indirect. Even through Ownerscope. 2024, that's... Okay, so 2023, it was some people join our community, and all they do is they buy a property a year from people in the community. Or maybe one a quarter, one a month. But all they're doing is buying deals from other people because there's a lot of wholesalers. Well, wholesalers don't make money unless people buy deals. At that point, I was actively wholesaling cash deals. I was slowing down cash deals and focusing more on creative deals. Well, I learned that pretty quickly, cash wholesaling is way better active income source than creative deals. Because cash wholesalers, you're pretty much looking at, are we good on time?
Yeah, you're good.
Okay. Cash wholesalers, like, the property is worth this much, and you're locking it up this much, your spread can, well, not this. So if it's worth this, and here's what you lock it up under, you get this spread. And there is a much bigger spread for that than there is for a creative deal, where most people are buying creative deals as a rental. Well, as a rental, every $5,000-$10,000 you add to an assignment fee, that starts to really impact your cash on cash return. So there's a much smaller amount that you can charge for a creative deal, unless it's already got a lot of equity potentially, but then you can for cash deals. So there's like a very quickly you get to a ceiling on creative deals. You can cash wholesale deals for $50,000, $100,000 spreads. Not all of them, but depending on your market, you can get $50,000, $100,000+ for cash deals. For creative deals, some of the best ones are maybe $25,000 because $25,000 in your entry is going to have a really large impact on your cash on cash return, which is what those buyers are looking for. Does that make sense?
Yeah.
So when I understood that okay, I'm getting $5,000, $10,000, $15,000 for all this time and energy that I'm spending. Who here has wholesale or tried to wholesale? Okay, well, what do you guys do instead of wholesaling? What do other people do?
Buy and hold.
Everyone in here just buys and hold?
I flip.
You flip? Flip? And how are you guys primarily getting your deals?
Wholesale.
You're wholesalers?
Locally sourced.
Locally sourced? What's that mean? Like agent connections, or you guys build
Yeah, agent
meetups?
connections, and just knowing my area.
Mm-hmm.
Yeah,
Off-market deals.
yeah, off market.
Couple
Off-market deals?
yeah.
Okay.
Direct mail.
Direct mail. Okay, so direct acquisitions. So I very quickly learned that some of my best wholesale deals that I was selling were not necessarily the deals that I wanted to buy. So there was a inconsistency because I'm a buy and hold investor. I wanted to buy more deals. I thought I'll go direct and buy my best deals and wholesale the rest, right? You hear that all the time. But I realized my best deals to wholesale were not the deals that I wanted to buy, which fine, wholesale those deals. But then if I wanted to really make a lot more active income, I would need to find more of those great wholesale deals. But that wasn't going to necessarily allow me to buy more deals. What that was going to do is get me more active income to then be able to buy more deals. Well, here's lesson number 2. Pace taught me. Oh, I don't even think I said lesson number 1. I'll get back to lesson number 1. Lesson number 2, I don't need to use my own money to buy and hold real estate. There, like he said today, you become a billionaire from the 99%, not the 1% that will, and I guess that's really specific to me as like a coach and a mentor, like that kind of stuff, or people who like, for the workshops and all that, that's like 1%. But then 99% will see what you're doing and say, I don't want to do that, but I want to be part of that, but I don't want to do all that work myself. So it was, I'm going to learn how to raise money instead of trying to focus on building my active income through wholesaling so that I can eventually buy a deal after I wholesale a bunch of deals or do a couple fix and flips. I'm going to just go all in on developing the skill set of raising money, all these various things I talk about, really understanding deal analysis, how to structure deals for the right partner so it's in alignment with them to maximize their end goal and my end goal, right? That's alignment when you're pretty much when everyone's getting their things solved. And I decided to go that route instead of relying on my own income. And in hindsight, when I reflected back on this $8 million that we acquired, I leveraged the Pareto principle, 80-20 rule. I realized the majority of my deals that I were buying were coming from wholesalers, not through my own direct acquisitions, because once again, the deals that I wanted to buy were not necessarily the deals that we were wholesaling. So my direct acquisitions were not necessarily deals, they were not generating the deals that I wanted to buy. They were creating me more active income, but that came at a cost. That took my time, money, and energy to, at minimum, choose motivations, pull a list, skip trace the list, put it in my CRM, write letters, whatever, reach out to them, filter the majority, have some conversations, see who's really motivated. You can outsource pieces of that, but the more you outsource, the more cost it is. And I realized real quickly, I'm going to just buy other people's deals because I'm going to pay someone $10,000, $15,000 on these creative deals, and I'm going to pay them at closing where they got to spend all the time, money, and energy to potentially get a deal to sell me. I'd rather just buy their deal instead of me being the one trying to do all this work to potentially buy a deal, because that time, once again, it's a trade-off. I'd rather spend that time finding more deals and raising more money and getting better analysis, all these things that I'm talking about, right? I'd rather spend time and energy focused on that than trying to make active income or do my own direct acquisitions, understanding that when I pay a cost, it's at closing. And if I'm raising the money for those, it's not even my funds. I'm not saying, don't think of it lightly, it's a very important thing, but understand that there's a lot of costs associated with doing your direct acquisitions. People don't necessarily quantify that. They look at a $10,000 wholesaler fee. People spend $10, $20, $30, $40, $50 plus $1,000 trying to wholesale or do direct acquisitions with little to no returns. Some people are very excellent at it and they do get solid returns and they might even get better deals. But for the sake of scalability, it was better for me to buy wholesaler deals, and that a lot of that came from reflection and kind of just looking at it like 80-20 rule, right? Like the majority of my deals and the most convenient ones were just buying deals from wholesalers, and I didn't have to spend any money or energy. No, I had to spend energy, but no money finding those deals. I would rather, instead of talking to sellers and identifying motivation, and then for the few that end up penciling out, like, I'd much rather, from anywhere in the world, any time of the day, analyze deals that people are sending me, and then I could train people. I could train bird dogs. I could train an underwriter, do a lot of that initial filtering, to then bring me better investment opportunities that fit my buy box. Then I would decide if I want to buy that. I could scale that more so. If you ever tried to scale yourself out of a wholesale company, you'll realize that's really hard to do because it tends to fall apart. Doesn't mean that's the case for everyone. Most people can't even get started with wholesaling. They lose a lot of money and then give up. And it takes a lot of commitment, and you're dependent on your sellers and their timelines. Whereas when I have a deal from a wholesaler, what I am doing is I am deciding, do I want to buy this thing as is? Do I want to renegotiate this deal, or do I want to move on from this deal? Without any money spent, but there is time spent, so you got to do that. But I can leverage other people who want to be part of these transactions or get paid a fee to do some of that work for me to free up my time so I can spend more money, so I can spend more time raising more money and building more relationships to get me more deal flow. Does that make sense? So most of my deals come from wholesalers, not all of them. I buy properties on market using DSCR loans. Even when I buy cash deals and burn them, most of those tend to come from, those come from wholesalers. And creative finance deals, I am very rarely doing my own direct acquisitions. Sometimes I will snipe a certain deal that wholesalers cannot bring to me anyway, like a multi-million-dollar luxury property in San Diego with like virtually no money to get into that deal. Wholesalers most would not be able to do what I did on that deal. So certain times I will snipe certain deals, but that's my main way of scaling is buying deals from wholesalers, but understanding that the majority of deals from wholesalers tend to suck at face value. Well, you're going to spend time and energy identifying which ones are good, which ones you want to move forward with, or understanding the potential in those deals if they were to be renegotiated, because most wholesalers know how to put a motivated seller under contract. They don't understand what's a good deal for an end buyer. That's why most wholesaler deals don't end up getting sold. Our job as the buyers, the buy and hold investors, is to identify which are the great deals we want to own, but a lot of people know which ones those are, or to help restructure, renegotiate those deals to see if they are great investment opportunities for you, if they can be renegotiated. That's the majority of my deal acquisition. That's like 80+% is that exact strategy.
Out of your total deals, how many deals do you renegotiate versus just buy as is?
I don't have that number on me. I'd say at least half I'm renegotiating, because the best deals that are like, oh my God, it's a phenomenal deal, you're not the only one who wants to buy that deal. You've seen the deals with 300 comments in there in the Facebook groups and Discord channels and whatever. You've seen those deals. So if it's a great deal at face value, you're not the only smarty pants that knows that, right? So where you can have an advantage is identifying the potential in deals and helping restructure those if it's viable. It's not always viable, but if you're not giving yourself a chance, like I didn't give myself a chance by not making offers, right? Like, could I say, oh, that's not a deal, I guess at $300,000, I guess it's not gonna work? Or traditionally, what do? Well, would you be open at $275,000? Right? Like, I don't know why we think that it's like, oh, it's all set in. Yes, it's under contract, but if that deal doesn't sell, and these are typically motivated sellers, or they're, even if it's just seller finance and not overly motivated, they were willing to sell, but the deal doesn't make sense for me. I come into it fairly analytically, present the numbers, say, hey, it's got to work for you, obviously. You don't have to accept any of this, but it also has to make sense for me as an investment. If we can structure it this way, I would be more than happy to buy that deal. And then pulling the right levers on every single deal, well, if I'm asking you to give, maybe if I'm asking, it's a give and take, right? Like, it's like, if I'm asking you to give, maybe I'll give a little bit in a different area. If I'm asking you to drop the interest rate so that I can increase my cash flow, increase my cash on cash return, maybe I'll give in a higher purchase price or whatever, something like that. I mean, that's usually what it is, right? That's like the easiest thing to do.
And between creative versus like cash buying, what is the ratio of buying creative deals versus cash buying, mainly from CoLiving strategy?
What was the question?
No. What is the ratio of you buying cash?
I don't have these ratios. People always ask me KPIs, and it's, I don't fucking know. Like, I'm not sitting here plugging this into a thing. However, I will say I prefer to buy the majority of my deals creatively for the sense of scalability, because every cash deal that I buy, even if I'm able to pull my money out, it's a perfect burr deal, that took me more time and energy. I had to tend to raise more money, or there was more risk involved with the hard money lender. If I'm raising just a little bit through a PML, we're gonna cash them out, there's still more risk involved with that. Maybe I end up with a better, newly renovated property, whatever. That's less scalable because that takes more time and energy than just buying a creatively financed deal, funding it through a capital partner, and then just adding a few non-load bearing walls and getting it operational right away. There's a reason why, and I'm doing a training on Saturday, it's wrapping up a 4-part super investor training series. It's free to everyone if you guys want to register. Links in my Instagram. But there's a reason why I primarily advocate. It's not the only thing I do, but why I primarily advocate buying creatively financed deals. It's the most scalable and it gives you the most wiggle room to renegotiate. Not every deal, right? If it's a sub 2 deal and it doesn't work, it doesn't work. Like it does not. Maybe you could lower the entry. If it doesn't cash flow, what are you going to do? There's really nothing you can do. You have to understand that and move on from deals. The majority of deals that we look at, you have to move on from. They just don't make sense and there's no way to renegotiate them. Buying creative finance deals is more scalable than traditional financing. Takes less time and effort than a BRRRR deal, even though I have some phenomenal BRRRR deals. And we have instant equity, hundreds of thousands of dollars, and we own them outright because we don't have to put any money into those deals. Like, by the time it's all said and done, right? We've cashed everyone out instead of leaving money in the deal. Creative finance, capital raising, as opposed to me trying to wholesale a bunch, fix and flip, earn a bunch of active income, lend my way to then be able to generate $100,000 to buy a deal. I'd rather develop the skill set and further raise capital to buy my deals. So that's also more scalable. And I believe it's more easy and feasible than it is to just build the money on your own. I think that's where, and I made a post up too about this, right? Like you will always be bottlenecked in your investing journey by your own funds. And out of principle, I have a lot of money. I'm just saying I could fund more of my deals, but I choose not to out of principle. I lend my money out to other investors, and I exclusively use other people's money to fund my deals, even if I'm paying them a decent percent of interest or I am giving up ownership in these deals, because my money will never be the bottleneck for me to be able to buy great deals. But if I start getting comfortable using my own money and using that as a crutch, I guess at a certain point you could, whatever. But if I do that, that could then be my bottleneck to be able to buy more great deals. So out of principle, I exclusively raise money for my deals. I do other things with my money. And then the co-living model, because of a lot of stuff I mentioned, more accessible, higher cash flow, higher cash on cash return, better ownership benefits, right? Bigger, better properties. They tend to be less competition because the majority of people are still only looking at long-term, or they have these ridiculous buy boxes or whatever. But then I gotta buy these bigger, better properties that have better cash flow, more accessible, higher cash on cash return, higher, they're worth more, so then I get better appreciation. Even if it's the same 5%, appreciating $1 million versus like, okay, $400,000 or $500,000 is different than appreciation 5% on $100,000, right? You get with that? Like, it's 5% appreciation on a $100,000 house, that's appreciating $5,000. $500,000 house, that one deal is now $25,000 appreciation. And that is also compounding with time. And the debt benefits that are associated with it, the debt pay down, right? It's a bigger loan amount, same interest rate and everything, while I'm paying more of that debt down every month because it's a larger debt payment, and I get more tax benefits. Because of all those things, it makes it so that I have less competition to buy these deals, and because it's got better returns, cash flow, and ownership, and it's a more trending topic, it makes it easier to raise more money. That's my super investor cheat code, essentially. Creatively financed deals primarily from wholesalers, capital raising to fund those deals, and then co-living as the main management strategy. Piece all together. Does not mean that's all you should do. Does not mean that's the only way I buy deals. Does that mean I only look at properties that only make sense for that? Outside of capital raising, I'm very flexible on the front and back end of properties. But the majority of them make a lot of sense, like the acquisition, the management. The capital raising is pretty much my non-negotiable. But having all those various tools in your toolbox, identifying when's the right opportunity, when's the right time to use those, but understanding like this is kind of what I've personally defined as the best strategy, pretty much based on numbers and other people's experiences as well. Cool?
Yeah.
Okay, so 2023, OPD and OPM. Other people's deals, other people's money. That was my big takeaway. And offload low dollar per hour tasks. And I want to say like lower dollar per hour tasks. Okay, so in this, I'm going to put those things that could be done by people. Maybe it's not necessarily a low dollar per hour, but I have a higher dollar per hour than whatever that is. So lower, here, it's not low, it's lower dollar per hour. So you might be paying someone a lot of money, but if you can make more money or raise more money or find more deals, that's still a lower dollar per hour than your own dollar per hour, right? So understanding that kind of stuff. Kind of what is your time worth, even if you're just spitballing. You say, hey, I'm $100 an hour, everything less than that, I'm going to outsource that. Whatever the number is for you, there's a variety of ways to calculate that, whatever. And to service providers who are more knowledgeable and experienced to minimize the risk for me and my partners in the long term as well. 2024. So I mentioned my favorite part of real estate investing compared to other investment strategies was the fact that I can leverage, right? I only thought of that in the sense of I can leverage the bank's loan, the seller's loan to buy this larger asset, but I didn't understand necessarily the concept of leveraging other people's. Well, I started to understand the concept of leveraging other people's time here, but I didn't understand leveraging my own time to scale in the sense of content and leverage, the one to many. I was burning myself out at the end of 2023, freed up my time, and I am a people pleaser, a go-giver, a helper. It has played a massive role in my ability to get more deal flow, build more relationships, raise more money, yes. However, it comes at a cost of my time, and at a certain point, me as someone who likes to help people, what I hate on the other side of the spectrum is people asking me for help, they seek me out, asking for help, I spend time and energy with them, and they don't take action. That shit drives me crazy. And that's the majority, unfortunately, less so in Owners Club, but that is the majority of people, and every new community that you're part of will say, or like, no, the various levels of sub 2 to Owners Club and all that, the higher you go up, the less people will waste your time. But the lower you go, the sub 2, and because Owners Club is new, right? Like it was like sub 2, Mastermind, now Owners Club. But then like sub 2, there's still a lot of people who waste a lot of your time by not taking action. And I had to learn, okay, that's not working for me. It's driving me crazy that they're asking for help. I am the type of person who wants to help them. I try to help them, and they don't take action with that. Well, I could have done anything with that time. I could have further benefited my business. I could have worked out. I could have spent time with my wife and my baby. I could have gone out in nature. I could have literally sat there and watched Netflix, but I went on my way to help this person that seeked me out, and they didn't do anything with that. That, I don't want to say it's disrespectful. That's how it feels, but it feels like, damn, dude, like this could have been what you needed. You asked me for it, and you didn't do the thing. And I get this mindset and this and that, and then don't waste my time. Like Pace said earlier today, like, then go talk to a therapist. I don't know. I've never been the guy to like, I don't want to do that. Like, I got my own stuff to do with. I can't help other people with their mindset, but I can help you with tactical, strategic stuff, right? And that's, if you're asking me that kind of stuff, I'm telling you, well, if you had mindset issues, go to Matt Peckman's, right? Or whatever. Like, go, he can help you with that. But then, so content and leverage, the one-to-many model. In my one-on-one with Pace last year, I told him, Pace, this is the second time I told him. This is August of last year. August 2020. So we've added multiple millions more dollars here, whatever. Like, just keep adding real estate, same concept. It's the same thing, and then you get newer levels. We promoted an operations manager to an asset manager. We decided to bring certain management, property management back into the business and hire virtual assistants because we were paying over $12,000 a month for property management. I said, well, shit, dude, I can hire and grow and scale my team to then do all of that stuff themselves at a much lower cost with better results. So that's why people ask me, how do I decide when we brought property management back in-house for some of our portfolio? That was how. It just financially made no sense because I had more than enough money that I was putting out that can then go and fund a team to help do that, or more in-house, and consistently more standardized than, because I own in over a dozen markets, various strategies. So there's different property managers, they all do things a little bit differently, and then they send it to my bookkeeper, and that's all a little bit different. They send, so it's all a little bit different. Well, if it's internal, we can standardize that process, have all the same reporting, all the same understanding of our properties. So that's how I decided to do the property manager, bring it back in-house. But not with me. That was the one thing. I hate property management. I hate private more than anything else. Well, bookkeeping. I don't know. Between those two, I hate both those two. Actually, ironically enough, it wasn't just Pace. So I have this photo that I hate of myself in 2022 when I met Pace at the meetup, and it's me talking to him, and it's this photo of me with my hands out, and I'm like doing this thing, like I'm like listing things off. Here's all the things I've accomplished. I'm crushing it. 26 years old. Like I don't need shit. I know everything. I'm like crushing it. I don't know if that's true. I don't think it was necessarily like that, but I thought, yeah, like I don't really know who this guy is at the time, and I thought, well, I'm doing pretty freaking good. I don't know many people in my age group who are doing what I'm doing. There's a very small percentage, especially with the upbringing and the challenge that I've had to deal with to get to the point that I was at, and a lot of it in the military, but okay. And when he told me that I created a job that I hated, and when he told me that I was doing things wrong and I can improve, I kind of lied to you guys. I skipped a piece. It wasn't that he just told me that and I said, you're right. I'm going to offload property management. I'm going to offload these things. It hurt the shit out of my pride. It made me feel like, dude, what are you talking? How would you know? Right? Like someone tell you something and you're like, but obviously I've been doing well. They tell you you've been doing it wrong, or they think they have advice for you, and it's like, you may not believe them, or your pride will make it hard for you to believe them. and it might hurt your ego because it's going to hurt your ego. You thought you were crushing it, and you weren't. Like, hey, here's some feedback. Even if he means it in the best way, it may not be received that way, and it wasn't. And so I took some time to reflect, and I had a short-term rental tenant message me at 11 p.m. at night because I ran out of cooking oil, and I was like, yeah, F this. Like, it literally was that. So I hit my ego. I had to take time to reflect and listen to what we said, and then it was one short-term rental tenant asked me for cooking oil in the middle of the night, and I had to, like, deal with this damn thing. And I was like, yeah, okay, this really is the reason. I thought, no, I don't hate it. You justify it and you say all these things. I mean, people do it all the time with everything. Like, we kind of know what we're doing. These rooms now that we're in, it's ironic for me to be here talking like this. You're like, guys, how's that even possible? You've learned and all. Yeah, but it wasn't always this way. Like, I wasn't always with the mindset that I have now that I'm so... I can't even justify paying $3,000 for my first ever education in the space that ended up within months getting me a massive ROI because of mindset issues. And so when Pace told me that, I thought, no, it's fine. I got to figure it out, whatever. I reflected on it, right? It's hard to believe it in that moment sometimes. You need some time alone, not in a meetup with 100 plus people, and everyone's like, Pace, right? We got a cult following, right? We love Pace. And you're like, well, yeah, whatever. I got this. But then it was that moment that really triggered it for me. Why did I share that? Whatever. I don't know why I shared that. But it took me took more than him telling me with all of his knowledge and wisdom. I had to take some time to reflect on it. And it took an incident to realize, oh yeah, let me get rid of property management. Like, it was really that. And I said, well, yeah, now that I don't have to deal with this, I have more time to enjoy my time. And then started offloading more things after that. Actually, I waited to do the bookkeeper until after that. So I took that.
Question. Would
Yeah,
you,
please, why don't you-
knowing what you know now, would you have started that from the beginning?
What?
Knowing that you don't like doing the operational.
Oh, okay.
Is that what past plans?
I believe my experience managing my own properties, doing some own renovations, using traditional financing, doing some wholesaling, all have played a role in my ability, have benefited me in my overall journey. However, knowing everything I know now, I think I could have came to the same or similar knowledge or never even needed that knowledge, in all honesty, by hiring and delegating and outsourcing the right things to people who are better at it than me. So I needed it because I was doing it. I needed to develop those skills so I can keep doing it at a higher level. However, and that is an advantage. Like, if a contractor sends you some quote, you're like, well, that doesn't make sense. But you can also just, like, shop around quotes. You can get multiple quotes. You can talk to people. You get referrals. You don't need to have, like, exchange flooring or done drywall or do all these things to know that. But I see how that has somewhat benefited me. But I think you can get the same result without actually doing a lot of that stuff. So in hindsight, no, I think it would be disingenuous in my journey to say it didn't benefit me. I think it did. Because it showed me why it was so important for me to do things differently this time around. Or, like, as I grew to new levels. Remember, it's been 5 years. So, like, I'm doing a lot of learning and a lot of scaling in 5 years. I have been constantly overwhelmed and new problems and new challenges. But I like that. Like Pace says, I mean, I'm not always grateful for it. Sometimes I'm pretty frustrated and want to stop. But I also understand that it's good because I'm progressing and learning and whatever. And it was all very condensed. And I have very few peers. We have peers here, right? But, like, whatever. So I think in my particular experience, yes, it's benefited me. I think certain things of, like, some wholesaling and being better at communicating with sellers and structuring deals and all that was beneficial. However, I think you can get the majority of the benefit without ever having done it yourself. Especially if you're leveraging the right people and the right resources. Because I could have done it indefinitely. I still would have never been nearly as great of a property manager as other people. Because I was becoming a jack of all trades and a master of none, which is fine in the role that I have now, but it's not nearly as fine if you want a really phenomenal property manager. You want a really phenomenal person at looking at contractor quotes and validating what they're doing, like, whatever, all these different things. You want the person who's doing it to be really phenomenal. You're not ever going to become that in every area. And if you have to choose what you're going to become that in my opinion, and based on everything I've learned and implemented and skilled from, it's get great understanding deals, structuring them in such a way that makes a lot of sense for you to get the deals done, and structure in such a way that makes a lot of sense for your capital partners, and develop the skill set raising money. If your goal is scaling, I think that is a way better use of your time, and that's the thing you want to get really phenomenal at, as opposed to, like, Pace doesn't talk about me a lot because of my property management skills or whatever. Like, he talks because the deals, the capital raising, all those kinds of things. So, and there's a reason for that, because he is recommending people get good at those things. He's talked about that, and that was my 2023 lessons. And those are the skills that I think are way more beneficial, and you can skip past some of the other crap to get there. Does that help answer that question? Okay, cool. As of 2024, content and leverage. So I spent so much of 2024 on Zoom calls, and Zoom calls, and Zoom calls. Not even just like training calls, like one-on-ones, and at that time I was still full-time employed. I had over $12+ million, maybe over $15 million of real estate at that point. Still working my W-2. I don't think I would ever quit until what I tell you. But I spent so much time, like I said, helping people, and it was very frustrating to me at a certain point because they were asking me for help and they were not executing. I was like, what the fudge, guys? Why are you doing this? Why are you doing this to me? And then I don't understand why they would do that to themselves. And I understand maybe they have mindset issues or whatever it is. And I get it. We've all been there. I've asked for help and not followed through on it too. I get it. However, it was really messing me up that I was spending so much time away from things that I would rather be doing with my time. But because I'm a people pleaser and a helper, I was doing that. And they weren't helping themselves after the fact. They did the first part, but they weren't actually execute. And it's like, why would they waste my time and their time? Like, what was the net benefit for them? So then I told Pace, okay, so we had my first baby girl. All this that I've been doing, everything has always been for family. My mom, single mom, worked multiple jobs, had little to no time to actually raise us, be with us, because she had to work just to barely make ends meet. For me, I said I would never bring children to the world if that was the existence they had to go through. Because I think my most important role in life is to be a phenomenal father and a phenomenal husband. And if I could not do that because I don't have the time to do that, I wasn't going to do that to my kids because of my own experiences. Whether it's right or wrong, that was my thought process on it. So we had our first baby May of 2024, and I was working remotely, doing all this stuff, getting very overwhelmed with one-on-ones, and I said, I'm done. I'm done doing these one-on-ones with people. I'm just not going to do it anymore. In August, they asked me to come back in office. It was remote, so I kept going. I said, dude, you guys know I just had a baby. I'm not going back into office for sure, especially not full-time. And I manage a lot of people, so then they wanted me to be the one, then get everyone else to come back in as well. I said, I'm definitely not in agreement with that. My staff is great remotely. And then that was why I decided to retire from my W-2. It wasn't like a money thing. I already surpassed all my money goals and all that. It was, and I really enjoyed my work, but it was that moment where I said, well, I am giving up a lot of time and energy to do this job, and I don't need to work for the money anymore. I'm going to spend that time and energy with my family, and they were trying to force me back into work. I said, no, whatever. I don't know where I'm going with that. But at that same time, because I retired from that, I had a one-on-one with Pace, and I told him, Pace, I think I'm going to retire from everything. I don't need to really scale my portfolio anymore. I have over $20 million close to $20 million of assets. I have more than enough cash flow coming in. Every single month, my wealth is building, and every single month it gets better and better because the debt gets paid down, the appreciation increases, tax benefits or whatever. But I don't need to do this anymore. And he told me that I was basically doing the same thing I did the first time, where I created another job that I hated in a sense of, and I told him I was very overwhelmed with the amount of help that I just don't want to help anyone anymore. I literally did not want to help people, especially not individually in the way that I was doing. And that's why 2024 was the year of content and leverage. Not to say I wasn't doing some content and leveraging to some extent, more so for deals. I was more so doing it for deals and to help other people to some extent. That was my goal, but I wasn't doing it at a high level. And it was helping me raise capital. So it was like content for the sake of deals. So I got posts and stuff too and all that stuff that were beneficial. And then people want to work with me and we raise money. It's a big part of my generous expert capital raising model. But I wasn't doing it as intentionally to help other people. And that's where I shifted, where Pace said, okay, well, you need to just keep helping people, just do it in a different way. Do it at a higher leverage. You can't keep doing one-to-one. There's only so much time in a day. If you want to have the impact that you want to have, you're not going to have it through one-on-one conversations that are hour-long, especially if they're not going to take action. What you can do is create more intentional content, more intentional value that the right people will find, or you present it to them and they will find it and they will learn from it and they'll execute from it, and then they'll be part of your future things that are then more in alignment, and you've already filtered the wrong people out for that content. It doesn't take me any more time to create a whole video for one person than it does for 1 million people, right? So that one video could help 1 million people, not my videos, I don't get that many views, but could help a lot more people and could filter out the wrong ones without me having to have a one-on-one call with them. So I'd free up my time. So I'd have more impact with less time, and I could do things way better than a Zoom call. I could create presentations, like I'm doing these webinars, I've got trainings and all that. So when I created my free school community, it's like school is like Kajabi, but just another platform owned by Hermosi or co-owned by Hermosi. And so I have this free school community called Wealth Through Real Estate that recently surpassed over 1,350 members. That's pretty sick. Thank you. That's pretty sick because I think of all those people that I'm helping, and I can help them more intentionally because it's like, I tell people now, like, you don't even want to have a 20-minute call with me. There's only so much value I can provide you in 20 minutes, and it'll overwhelm the shit out of you. When I have trainings and tools and resources sequentially there for you to help you when you need it for the different things that you need help with, way more beneficial than a 20-minute call. So that's when I got very intentional about freeing up my time while simultaneously providing more value. And then he gave me permission. I was, I think, probably the first person in Owners Club who asked or got permission, then do some type of paid mentorship and education. For those people who are in a different position, who know that this is a thing they want to do, who want to emulate what you are doing, it's okay to charge for that. Have a unidirectional value exchange. As long as you provide them significantly more value than the money that they are providing you, then it makes a lot of sense. You shouldn't feel bad about that. I said, I don't want to do this because I am part of other people. I didn't want to do paid coaching and education because I was part of so many other people's communities and being like a guest educator in all these various communities where they like talk about short-term rentals or mid-term rentals and whatever. I'm talking about, I'm helping them with guest coaching on creative financing, deal structuring, capital raising, all these various things. The people who are making a bunch of money, these gurus that are educating are making tons of money. They have a tiny portfolio. They have little to no experience, but they're really good at marketing and they're selling this product to people, selling a dream, but they don't even have the actual delivery, the fulfillment to actually help people accomplish that. And if they are, the one thing is the management strategy, not how to find deals, how to analyze the right deals, how to fund those deals. It's like, here's how you have a short-term rental. But like, they don't show you how to do any of the other steps. And he basically told me, stop bitching about it. Just go do something about it. And that was pretty much how I transitioned into understanding, once again, this is now you're seeing some of the very direct impacts PACE has had in my life. This 2022, and then there was a lot of indirect impact in 2023. 2024, again, on my one-on-one, the Owners Club one-on-one. And that's what I did. So he said, basically, just go be that change. Don't complain about the people that suck at it. Just go be that change. And that's where today when I mentioned, like, it's crazy to see the vision of everything we've been able to do. Well, everything PACE has been able to do, but seeing all the leaders all over dominating every single space, and we're just starting as a community. We are literally changing the landscape. Like, sub 2 compared to Bigger Pockets, it's not even comparable. But Bigger Pockets is the other big guy, and they suck. Every part of what they do pretty much sucks. Not that I didn't learn from their forums and all that, but it was like a totally different place than sub 2. And now we have this community of educators and leaders in all these various spaces that are helping people actually accomplish things that these other communities where all they're focused on is money for themselves, not how can I provide them so much value so that they can succeed on their own journey. Because that's the way we're taught, because PACE, that's the way he does it. He does deals with us. He helps us. He provides way more value than we ever have paid him. Who better as a role model to then learn from to kind of do something similar? So that all ties into leverage and content in the sense of taking all that one-on-one time I was doing for people for free, creating free community, free content, free education, tools, resources for the majority that need free resources. And those guys tend to be a lot of my capital partners. But I'm providing some form of paid mentorship and education for those that are ready for something at a higher level. And that is also now an active income source that was not something I planned for or necessarily needed, but it's a reality of it. Like, it'd be pretty disingenuous for me not to account for that. And I get that because I get to help other people on their journeys. It's like this phenomenal thing. But the reason why this is so important is the content and leverage has allowed me to help more people, which is a huge part of my why, free up more of my time, which is my ultimate why, so I can spend the time that I have with my family, doing all that, right, ties back into doing all this, to then waste all my time and energy on people who are not taking action, when I could be spending with my family that I said I was doing all this financial freedom, all this hard work for, to then when I have it, to not do that because I'm helping other people. It just seems fucking crazy. But I get to take a step back to realize that. You don't realize that when you're in it, you just feel overwhelmed and anxious. Like, well, I don't want to help anyone anymore. Well, that wasn't the issue. I was just not doing it the right way. I was not doing it the highest leverage way. And in reality, this content and my ability to help more people then took my real estate investing journey once again. And it's pretty like, I mean, these slopes aren't even like, this is a good slope. This slope was even higher. 2024 or 2025, it's once again like this. And when we talk about dollar amount, and it's even faster paced than it was before, and we talk about dollar amount, it's not just dollar amount in the sense of revenue. It's dollar per time or dollar per effort. And I think that's a way more important metric that is not necessarily accounted for, but this dollar per time / or effort has skyrocketed. In addition, on this axis, so dollar here, time here, but this could also be helping or whatever, I don't know, like impact, this impact, and then time here I've been able to drive up my impact per time, per unit time, and enjoy my own enjoyment. So this is fucking another one. Enjoyment, understanding why content is so important, not these influencers who like show you their outfit or whatever. Like, that's cool, right? That's cool. People do whatever you want to do. But like, if I want to have an impact, I can only impact the people that see me and know of me. Well, if I'm being intentional about creating content, then I can have a larger impact on people and help them out instead of all the majority of the content that's out there. It's all just a distraction and makes people hate each other. Earning per time has all continued to skyrocket because of being more intentional and leveraging through content. I hate social media. I'm not a consumer, let alone a producer, although now I've changed my mindset because you have to, because it's hard to do something well, and I'm still working on that. I'm still working on that climb out of like, okay, yes, I'm gonna invest my time and energy in the same way we're investing our time and energy into real estate and account raising and all that. Like, you could do that with content creation and all that, but we obviously have the ultimate cheat code with pace, because it's like, it's not necessarily about the views, because you can get a lot of views on a bunch of dumb shit. Actually, the dumber the thing, the more views you tend to get, honestly, because that's the majority. But I'm focused on the minority, the not normal people, helping them, providing them a massive impact. And that normal people, those tend to be the ones that will actually benefit from the free content, that will then tend to work with me as capital partners, tend to work with me and be part of the education and all that stuff, my own community stuff. So it's less about views, it's more about value. That's kind of how I think about my content. It's less about views, it's more about value, because I know I won't get as many views, but I know the people that watch it will get a lot of value out of it. And that has helped me massively skyrocket in every aspect to be able to enjoy my life more, because I'm putting less time and effort into this and providing even more value, the impact, and my dollar per time. For example, as I mentioned, in 2023, it was very hard for me to raise $50,000 on an objectively great deal with the management strategy already lined up and equity in that investment. Well, the more I did to help people, I was able to raise more and more money. Obviously, I raised millions nonetheless without being very overly intentional on content. But then when I got intentional on content with the idea of helping other people, I've been able to raise $800,000 in 72 hours, $450,000 in another 72 hours. I mean, everyone knows my name, I think, for the most part, so that's good. Delete things like this, right? Although I do talk a lot.
We all know it, we just can't say it.
It's okay. You only need like the first few letters on social media, so that's good. I've been able to help way more people. I've been able to raise money. People come up to me like, oh yeah, I'm partnering with you on this deal and all that. I'm like, that is awesome. We didn't even have a conversation yet because the content producing. The content producing is providing them so much freaking value, and they're seeing it so frequently. Like, I want to work with that person. This person is providing me so much value. I want to be part of whatever they're doing because I bet on that jockey for us all to succeed together. So with that, I bought much more deals. Way better opportunities are coming my way as well, which is like, I had a training for bird dogs, and I had over 100 people there live to learn how to bird dog for me. And I'm like, holy shit, now I'm flooded. I have too many deals. I can't even look at these deals. Like, I just genuinely cannot. So I'm trying to reposition it to my community so that they can get those deals. But I was saying, like, this has been my trajectory. How you'll take them?
Yeah.
Yeah. And then, yeah. Well, yeah. And this has been kind of a lot of this growth and all the stuff that I've had to do to get here on my buy and hold journey. Any questions about this before I try to knock out every single question we had before this? Co-living properties. Bigger, better properties in larger cities that are unaffordable to live in based on median household income. All right, so the reason why we sold our first ever co-living rental was because it was first actually a failed short-term rental. The market shifted, and that thing that was supposed to make X amount of money made less than that. And it didn't have the returns for our partners, and we learned, okay, well, we're in Atlanta, we learned about this pad split model. Let's try it out for that. We added an additional bedroom. It was slightly cash flow positive. Great, we took a negative performing asset to positive, but still didn't have the returns that we wanted. Thankfully, because we bought it at very low interest rate, very low entry, we were able to offload it to those guys that wanted to buy it for the tax benefits. Well, for us, but that property was the proof of concept that I needed, because we, even though it didn't perform phenomenally, what it did do was, it wasn't that hard to get the renovations done, to add non-load bearing walls to a property. It was like, okay, this isn't that bad. This isn't that much work to convert a living room into a bedroom. And we got the house filled up in less than 30 days. So it wasn't this arduous process. So that was the proof of concept I needed to say, okay, this model works, just not with the property that I had it in. So let me go find bigger, better properties that make sense for this. So that goes into, so then it's like my favorite type of co-living is those that I can have be no less than 6 bedrooms, ideally 7, 8, 9 bedrooms. You're not going to find the majority of properties are going to have that outright. You're going to have properties that tend to be 3, 4, or 5 bedroom, but they're, higher square footage, at least 1,750 square feet, even higher is better. Typically they say 1,500 square feet is roughly 3, you can get like 3-bed, 2-bath, maybe 4-bed, 2-bath. Every 250 square feet above that is roughly another bedroom. It doesn't always work out that way. It depends on the layout of the property and all that. However, it's kind of a good rule of thumb. And I don't like to buy properties that are less than 6 bedrooms at minimum because I can get close to $1,000 a month in cash flow at around 6 bedrooms. It's going to be market dependent, debt structure dependent, all that stuff. But as a rule of thumb, your 1% rule, whatever, that's kind of where I'm at for $1,000 of cash flow. And I don't want to buy deals that are less than $1,000 of cash flow for me personally. So then the 7, 8, 9 bedrooms is what then allows you to then get closer to $2,000 or more cash flow per property. So when you know you have opportunities to do that, that's a goal. Another big thing is those that have more bathrooms are better because you want each bathroom to have no more than 4 people sharing it. A 4-to-1 ratio of bedrooms to bathrooms. The lower that is, like it's a 3 people sharing one, the better. 2-to-1, better. If you go 1-to-1, great, but those are a lot harder to find where you have to do full new construction or massive renovations to get there. For the sense of scalability, it makes more sense to find a 4-bed, 3-bath is solid, and then turn that into an 8, 9-bed, 3-bath, because I don't have to renovate bathrooms, which tend to adding non-load bearing walls to make a living room a bedroom or an office into a bedroom is so much easier, and you don't necessarily need permits. I mean, you need permits, but you don't necessarily need it. Much lower risk than converting a bathroom, which is more time intensive, more costly, and you should probably get that permitted because most septics are not designed to handle like additional bathrooms. Or they're designed for the number of bathrooms that are there. And then you want to ideally do them in markets. I already talked about that, passive markets. And then the more unaffordable studios and 1-bedrooms are in a market relative to the median income, or if there's a significant $75,000 or less demographic, like that's what they earn, and the let's say 1-bedroom properties are renting for significantly higher, that's a good candidate for co-living. You want to have a spread between what you're going to charge by the room relative to 1-bedroom, right, units. Someone's going to have a co-living rental in a shared common spaces versus 1-bedroom. They better be saving some money. And there better be a lot of people that need that, which is, expensive 1-bedrooms, and they're not making a ton of money in that market. That tends to be most major cities as well. Like, that honestly is the case. Okay, and this is not like a hard and fast rule. A lot of stuff I mentioned. I have a 4-bed, 3-bath in San Diego that's rent by the room, and it makes phenomenal returns. But that's in San Diego. Like, it's a different market than in Atlanta or whatever. So, rules of thumb.
What is the view of co-living versus sober living?
Huh?
Versus sober living. Are you also into sober living or
yes? But with sober living, I'm not operating my sober living properties. I'm outsourcing those to nonprofits that will operate those. Mm-hmm. Does that make sense? Because that's not the highest best use of my time to operate those, as opposed to rent them out long term to someone else who will operate them. Okay. How to acquire co-living properties? I talked about most of my deals are from wholesalers. The luxury is that most people are looking at long-term rental, mid-term rental, short-term rental. We still have a lot of opportunity in the co-living space to take advantage of it before others will, because they will catch up on it. And you're going to regret it in 2-3 years when you don't have a co-living portfolio. And you're going to say, I wish I bought it 2-3 years ago when everyone else was doing it. And we have a phenomenal opportunity with creatively financed deals right now, and it's only getting honestly better for us as interest rates stay high and the market's crazy. Like the housing prices go down, that's more motivation for sellers to sell creatively. As we have a lot of volatility politically, all that is a benefit to our ability to be able to buy more creatively financed deals. The more normal the market, the easier the economy is. Well, the harder it is, the more opportunities there are for people like us who understand how to leverage that. So primarily from wholesalers, looking for bigger, better properties in pad split markets typically. Acquisition market. Pay a wholesaler at closing, way better than paying a bunch of time, money, and energy to try to get a potential deal. As a wholesaler going direct, I'd rather just buy that deal from a wholesaler. Org chart, we explain the crap out of that for the most part, right?
Just on acquisition, what are your key points? How do you do a comps and other things?
Okay, I'm not going to do that. Just because I want to get through a lot of these things. Okay, because I can't talk comps right now. All right, entry fee for co-living. Why is it higher than a long-term rental? Well, because your entry fee is your acquisition cost. Whether you're buying a long-term rental, mid-term rental, short-term rental, it doesn't matter. If you have cash to seller, you have an agent commission, you have a wholesaler fee, it's the same acquisition cost. That's bucket one, but it's got some subcategories, right? Your closing costs, all that's in there. Then it's your renovation or furnishing costs. Well, if it's minor renovations, you're putting $1,000 to clean it and a little drywall touch up. What's significantly less on a long-term rental than a property you have to add non-load bearing, like add walls to and furnish, right? So that's why it costs more. And the carrying costs are also higher because your expenses are going to be higher because you're going to cover utilities and all that kind of stuff. And you might take even longer, more months of carrying costs. So your entry cost is higher than if you bought a long-term rental because you're renovating and furnishing the property, and your carrying costs or reserves tend to be a little higher as well. Oh, how to move quickly with capital partners? Yeah, you got to pre-raise capital. Like I said, it was even with the most phenomenal deal because I didn't have visibility and I wasn't developing relationships with potential people to see if they would be good capital partners. I waited till the deal. It was very hard. Thankfully, we got it done, but it was still much harder. So the way to quickly move forward with capital partners is to already do all the heavy lifting with capital partners before the deal is there. Because you can present deals on what you're doing, you can sell your vision, you can build relationships, build alignment, and understand what a capital partner wants before you even have a deal, and then make sure you structure deals for them. And every capital partner you work with has different goals. Like I said, those other people, they're working with people who are primarily focused on tax benefits. For me, based on my capital raise, it's kind of all of it. There's no skew towards any one thing besides maybe cash flow, cash on cash return, and working with a more proven operator so they can also learn through me, with me. Percent split, it's going to depend on your ability to raise capital. So the more capital partners you have, the more people that want to fund your deal, you could tend to keep more of that asset. The better the returns, the more of that you can keep because you only have to give up less. So if it's lower returns, you're going to have to give up more to get them the same return. Right? If your deal's 10% cash on cash return versus 20% cash on cash return, you can give up, the lower the return on the property, the higher you have to give up someone else so they get the equivalent return, right? If they're looking for 5%, 10%, whatever, you have to give up more to get them that, right? How to know when to exit. This is return on equity. Once you own properties, you're getting the appreciation, you're getting the debt pay down. At a certain point, you do cash on cash return to decide if you should buy that deal relative to other deals, right? Then, once you own the asset as you're building equity, you determine, is the cash flow that I'm generating divided by my equity, is it worthwhile to keep investing? It's ultimately up to you to decide, is that worth it or not? And it tends to take 5+ years to build some substantial equity. I mean, I have like the San Diego properties. It tends to take a couple of years to really get the best benefits from ownership. And honestly, in theory, the longer you hold a property, the faster the debt is getting paid down. That's how a loan amortization works. Every month, you're paying the same monthly payment, but more of it's going towards principal, less towards interest. So every month, you're paying down more and more debt every single month you hold it. Same for appreciation, because it's not a straight line, right? Obviously, there's volatility and stuff, but because it's compounding every single month, every single year, we'll say you don't really look at appreciation monthly, but every single year, that compounding is increasing more and more. So you're building more and more equity the longer you hold an asset. You have to decide at a certain point, is that equity that I have in this deal, could I do more with that? Should I refinance the equity out of that deal? Should I sell it so I can get that equity out? So I can do something more with that money than just leaving it in this deal. So that's return on equity. So it's one of the main tools for deciding, should I keep that equity in this deal or should I move on from it, pull the money out and do something else with it? Okay? Or you have this long-term exit, kind of like I have, even though I do sell properties that have equity that don't make sense for me to hold anymore based on the current cash flow. Does it make sense for me to sell it? And then, like I said, like my big exit, right? Thing Pace and I talked a lot about, modeling it out over 5, really 10 years where we looked at it. And knowing that if I can have $10 million of equity, so selling my properties, 1031 exchanging them to a large asset, buying it cash, pulling money out, tax-free through a cash refinance, that property should be performing still. It's not, now you're paying debt payments on that, but it's performing, and it's a 6, 7, 8% interest rate loan. Well, I'm going to take that capital, that property performs, and not have to pay taxes on it. My family now has to only oversee one large asset or a few large assets, not a bunch of individual properties. And I take that money, I lend it out. These wealthier borrowers, maybe it's a better way to phrase it, that only work with higher tier clients, and that $10 million at 12% interest rate is generating you $1.2 million of interest, and that principal holds. And that's kind of my exit. There's going to be times throughout my journey where I sell properties like I've done because the return on equity, because the cash flow I'm generating no longer makes sense. I'd rather use that and deploy it elsewhere. But that's like understanding return on equity for your property when it's time to sell, and then understanding your overall exit. Because I don't think the majority want, I don't know, maybe you do, but to own hundreds of properties indefinitely and pass that on to someone who is not you. Like my wife wouldn't be able, I don't think she'd be able to handle the portfolio, no matter what the team looks like and all that. I think I'd be putting her in a worse position than if I kind of reduce that, or my kids when they're older. Like, I don't know, like, she's 13 months and our baby boy's on the way in a couple months. So like, I don't know if they're gonna be able to handle a portfolio like that. So I'd rather give them less assets, but then give them more of the reward, right? It's not about owning a bunch of properties, it's about the freedom it provides. And the less work to get more freedom, the better. And that's why, you got to understand your exit and understand how that works. I don't think very many people talk about the exit. Oh, 100 properties. Yeah. Just because at a certain point you develop these skill sets, even if you're buying properties, you can now leverage your ability to raise capital and your skills to then get into either similar assets, larger assets like groupings of assets, or into different larger asset classes because you're not ready for it in the sense if you have the right skills, but also you have your financial freedom met. That's a big part of the accessibility. Too many people focus on, okay, I'm going to find that one RV park that's going to make me free, understanding that may be more challenging for them. In my opinion, get yourself to 5, 10, 20K a month, Do whatever you want after that. Even if that means focusing on larger, bigger, longer time horizon assets. Whatever you want to do, but like get your financial needs met first, then you can have the options in life the tiniest percentage of people actually get to. Questions on any of that?
I think just for the future, also talking about not just exit strategies, but partnerships, right? Because we're really encouraged to squat up and to join partnerships. But there's also the ugly side of that. Right?
Yeah, I've had one.
And what now that you've gone through that whole experience, like what are you glad that you did, and what would you have done differently, and how do you set the exit strategies for those partnerships, right?
So I'll tell you something Pace told me. He told me this when my partnership's coming to an end. And he said, congrats. Because every single partnership will come to an end. One way or another, at some point it will come to an end. Why? Because at least one of you guys is going to die first. So it's going to come to an end. Even if it's the best partnership, it will always come to an end at some point. However, the more common thing that happens is one partner outgrows another. And if that happens, it starts creating issues and all that stuff. Or one person, you just no longer have the same work ethic or whatever. There's a variety of reasons why. But every single partnership will come to an end. It's honestly a way, it's going to be a part of your life that you are going to move on to your partners. That's why it's important to have really great structured season operating agreements on how that will be handled. That's going to depend on you and your partner, how you guys want to do that, how you would split assets, you could buy each other out, whatever. We had that. We had some buyout stuff in there. So I bought out my partner. He moved on. I moved on. He got some money. I kept the portfolio. But for me, I would recommend if you want to potentially find great partners, do kind of what I'm doing now. I would prefer not to partner with any one person on every part of my business. So instead of partnering with someone on everything, I'd rather partner with Jeff on a deal. I'd rather partner with Jeremy on a deal. I'd rather partner with a variety of different people on a deal-by-deal basis, date them, and then eventually decide, do I want to partner with them long-term and do more collectively together? Or, especially the way I'm doing it now, where it's like my partners tend to be, because my main value, one of the biggest values, is helping raise the capital for it and providing some experience and knowledge. Partnering with people who will also handle some of the operations and having clear-cut expectations for your partnership. That's a big one. We made all the mistakes. Thankfully, we had buyout stuff in there, but we made all the mistakes about you never think you need to clearly define roles and responsibilities or just figure it out and they'll do their piece and there'll be no issues, but that's not the reality of it. So date people. It's okay to partner on a deal or two or whatever, but don't marry partners too early until you date them for a while, and ideally date a lot of people. I made this analogy the other day, and it was ironic because my high school sweetheart and I have been married, and people I was talking to have been married for like 30 years, so it's like, okay, well, that wasn't a great analogy for that, but it's really good to date a lot of people because you might think that one person you dated is the perfect one. That's all you know. So date a couple people, do a couple deals, and wait for adversity to come. And when adversity comes, that's when you really know how a partnership is. Most people are great partners when everything's great and everything's humming along. You see the real reality of it when it's not working out well, when there is adversity. And you can only find out people's true character and be able to exit that if it's not the right thing for you in the long term by dating people instead of marrying them for everything that you're doing.